Discover the ultimate duo for traders seeking to mitigate risk and maximize profits. Trade like a pro with this book that combines 2 comprehensive guides on day trading and options trading to equip you with a powerful arsenal of knowledge and techniques for success in the fast-paced world of trading. Hello, this is Samuel Feron, and you're listening to Day Trading and Options Trading. Trade like a pro with winning strategies and precise technical analysis to succeed in trading stocks, commodities, Forex, futures, Bitcoin, and ETFs in any market condition. Provided to you by United Audiobooks. I hope you enjoy my audiobook. Now, let us begin. Introduction. Many years ago, the only people who could engage in active stock market trading were those employed by big financial institutions, brokerages, and trading houses. Online trading and the immediate transmission of news have leveled the playing field, or should we say trading. Retail investors can now try to trade like professionals more easily than ever thanks to platforms like Robinhood, TD Ameritrade, and Charles Schwab's 0% commissions and user-friendly trading apps. One of the most contentious issues in the world of investing is day trading. A long list of well-known commentators fiercely contends that day trading in the financial markets is little more than gambling. These pundits fervently contend that long-term investing will typically outperform aggressive trading strategies over extended periods. Day trading is becoming gradually popular as more people strive for financial independence and the flexibility to live as they choose. Learning the nuances of this fast-paced day trading environment requires time and commitment. Still, with the appropriate knowledge and careful planning, you can place yourself in a position to earn a fantastic living. Day trading has been characterized as little more than high-risk, short-term speculation by the investing icon Benjamin Graham, best known as the author of The Intelligent Investor. However, it is now easier than ever for the typical investor to start day trading because of the growth of the internet and the online trading platforms that have followed. To help new investors learn about day trading, we have created a general guide to help them avoid some of the losses many traders experience at the beginning of their careers. We'll go over the fundamentals of what you'll need to start day trading and the fundamental approaches many new traders utilize to capitalize on the daily price swings in the financial markets. We'll delve deeply into the world of day trading in this comprehensive book and explain what it truly is and how you may get started. Chapter 1. Introduction to Day Trading. Day trading is one of the most popular trading methods. Most financial markets, including those for stocks, foreign exchange, commodities, and cryptocurrencies, have active day traders. But is it a good idea for you to trade every day? How are day traders able to profit? Do you want to begin day trading? Unfortunately, these questions have no answer, but this chapter will clarify what you need to know before you begin day trading. What is day trading? Day trading is a type of trading method in which positions are started and exited on the same day. This approach may also be known as intraday trading since the trading takes place on the same day. Day traders try to make money from changes in a financial instrument's price using intraday trading strategies. The phrase, day trader, comes from the stock market, where trading is only available during normal business hours. Since their goal is to profit from intraday price swings, day traders never leave positions open overnight in this situation. The benefits of day trading. Day trading may be a lot of fun. Here are several benefits of day trading that draw people to this activity. Trading strategies. You can employ various trading strategies while day trading on all significant marketplaces. Breakout, trend following, and counter-trend trading, mean reversion, are common day trading strategies. When trading a breakout, traders try to profit on the early volatility that follows a price breach of a significant technical level, such as a chart pattern. When prices hit key levels and initiate pending orders, they tend to cluster above and below those levels, which causes a spike in momentum and volatility. As pending orders turn into market orders once the price reaches the pre-specified level, breakout trading also enables day traders to set a pending order to capture a breakout once it occurs. Chart patterns like head and shoulders patterns, triangles, double tops and bottoms, triple tops and bottoms, rectangles, wedges, and flags are common technical indicators employed by breakout traders. The volatility that follows a price break above or below a channel, trend line, horizontal support, or resistance level can also be used by breakout traders to their advantage. As their name implies, trend-following methods entail starting day trades toward the underlying intraday trend. Considering its appealing risk-to-reward ratio and high success rate, trend following is arguably day traders' most popular trading method. Wait for a price decline to be complete, for example, to a significant intraday Fibonacci level, before opening a trade in the direction of the underlying trend. Then, use candlestick patterns to determine when the trend will continue. Opening deals opposing the underlying trend is a component of counter-trend trading methods. Counter-trend traders aim to profit from market corrections that follow a protracted and significant upswing or slump. Only seasoned day traders should employ this method because it is slightly riskier than breakthrough trading and trend following. More trading opportunities. Day trading gives a lot of trading opportunities every day because it is a reasonably quick-paced trading style. Day traders primarily use intraday periods, such as the 15-minute, 30-minute, 1-hour, and 4-hour ones, to make decisions. This is a key benefit of day trading since those timeframes provide significantly more tradable setups than swing and position traders' daily or weekly charts. Remember, though, that shorter-term periods typically have greater market noise, which can cause losses to mount quickly if your stop-loss settings are too low. Try to gauge the typical volatility of the securities you're trading, using the ATR indicator, for instance, and set your stop losses appropriately to avoid this. There is no guarantee that more trading chances will result in more profits. Always stick to your trading strategy and only make trades that are entirely consistent with it. Be careful to only risk a tiny portion of your trading account on each trade because risk management is important to the success of day traders. Performance evaluation. Because day trading entails opening and closing trades on the same trading day, you receive your daily results very quickly. Day trading makes it possible for traders to know if they are making or losing money daily. In longer-term trading methods, traders often encounter unfavorable price fluctuations. To endure these swings, traders need a larger trading account and a great deal of patience and discipline to persist with their trades even when the going gets rough. Create and maintain a trading notebook with all the trades you make daily to track your progress. You can monitor your progress and search for trade trends that often cut into your gains or result in avoidable losses. News overreaction. The majority of traders on the markets are humans, and people have a propensity to overreact to news. For this reason, even when specific news turns out to be somewhat inconsequential for the markets, there will be significant price changes. You can benefit more as a day trader if you take advantage of that behavior. The actual amount is not crucial when trading the news, which is the most important thing to understand. What is important is how the actual number compares to the forecast. The value of the US dollar is likely to be significantly affected if, for instance, US non-farm payrolls come in at 200K when markets were expecting an increase of only 120K. Tech configurations. Day trading is a short-term strategy heavily influenced by technical levels. The emphasis swings from technical levels toward fundamentals as the trading window lengthens. Price changes can result from market noise in the very short term. Mean reverting gains significance during the medium term, and changes and trends in the fundamentals over the long term produce trends in the underlying security. Try to combine several technical tools when utilizing technical analysis for day trading, and only enter a trade once most or all of the tools confirm a setup. Another name for this is a convergence of technical levels. Disadvantages of day trading. Being a day trader has several advantages. However, there are also some negatives. The following are the main drawbacks of day trading. Increasing trading costs. Your trading expenses will be higher if you day trade than if you swing or position trade. Pick a broker with tight spreads and cheap trading costs because day trading necessitates opening more trades during the day. Some brokers provide preset spreads, which may appeal to traders who wish to time their trades to coincide with significant news releases while minimizing trading expenses. If you intend to trade significant market reports, you should know that news releases often result in high market volatility, slippage, and greater trading expenses. These trading expenses can quickly pile up over time and decrease your profits. Limited potential for profit. Day trading has a lower potential for profit than swing trading since day traders hold their deals for shorter periods and base their decisions on shorter time frames. Additionally, traders close their positions by the close of business, regardless of profit. The potential rewards of promising trading setups are constrained, even though this method eliminates overnight risk. Risk of excessive leverage in your trading. In most markets, daily fluctuations are minimal. As a result, day traders use higher leverage levels to maximize profits and profit from minute price changes. Although it can be quite effective, traders who over-leverage their transactions risk greater losses. Because it has two sides, leverage should only be employed by your trading strategy. A precise risk management strategy should be developed to limit your leverage or risk in each trade to eliminate the possibility of failure, i.e., blowing your account. Market noise. You must deal with more market noise the shorter the time frame you trade on. Market noise is chaotic and unpredictable price behavior without technical support or relevant news. Market noise is a serious challenge for short-term traders, and the only way to prevent being stopped too early is to widen your stop-loss threshold. Look at the pair's historical volatility and aim to place your stop-loss above or below recent levels of support and resistance to give the market room to move. Setting realistic expectations. Those trying to make a living or supplement their income may find day trading a feasible choice. However, having reasonable expectations and being aware of the associated risks is crucial. This section will discuss how to have reasonable expectations for day trading success. Recognizing the risks associated. Day trading implies buying and selling securities on the same day, often within a few minutes or hours. It is a significant risk of losing money despite the potential for high profits. Before engaging in day trading, it is crucial to understand the potential risks. Market volatility, which can result in abrupt and severe price changes, is one of the main risks. Unexpected news or events, such as political developments or natural disasters, may also impact the market. Another risk is that you won't be able to sell certain assets promptly and fairly due to insufficient liquidity in the market. To reduce risks, it's critical to understand the market and the assets you trade thoroughly. It is also advised to begin with a little sum of money and grow it gradually as you develop knowledge and confidence. Establishing specific goals and objectives. In day trading, having certain goals and objectives is essential. It enables you to gauge your success and progress while keeping you motivated and focused. Before you begin day trading, consider your objectives and set attainable goals. You should set SMART, specific, measurable, attainable, relevant, and time-bound goals and objectives. For instance, your objective can be to enhance your success rate by a specific percentage or to make a certain amount of money each month. It's crucial to have a strategy in place for accomplishing your objectives. This could entail creating a trading plan, strategy, and log to record your progress. Create a trading strategy. When buying and selling stocks, you adhere to a set of rules and regulations known as a trading strategy. It aids in decision-making and prevents emotional trading. Creating a trading strategy takes time and work, but day trading success depends on it. You can employ various trading strategies depending on your objectives, risk tolerance, and trading style. Trend following, range trading, and breakouts are a few popular strategies. Make sure the approach you select is compatible with your objectives, level of risk tolerance, and trading style. Before trading with real money, test your approach on a demo account. Manage finances and risks. Day trading requires both effective risk management and sound money management. They help in capital preservation and loss prevention. One risk management method is setting stop-loss orders, which instantly end a trade when a specific price level is achieved. If the market turns against you, this helps you reduce your losses. Managing your capital and spending is a part of financial management. It's crucial to establish and keep to a budget, refrain from excessive trading, and limit your exposure to certain securities. Constant improvement and learning. Day trading necessitates ongoing learning and development. You must be abreast of the most recent advancements and trends because the market is continuously evolving. Reading news and analysis, attending classes and seminars, and picking the brains of other traders are all part of this. Additionally, you should constantly evaluate your trading results and change your approach and plan as necessary. By keeping a record, you can discover your trading skills and weaknesses and monitor your development over time. In conclusion, day trading can be lucrative, but setting reasonable goals and understanding the risks involved is crucial. You can maximize your odds of success in day trading by being aware of the risks, defining specific objectives, creating a trading strategy, controlling risk and money, and constantly learning and evolving. Remember that discipline, patience, and hard effort are essential for success in day trading. Chapter 2. Understanding the financial market and market participants. The term financial market refers to any market where trading in securities takes place, including the stock market, bond market, currency market, and derivatives market, among others. Capitalist economies cannot function well without financial markets. Financial markets allocate resources and provide liquidity for firms and entrepreneurs, essential for properly operating capitalist economies. Trading financial holdings are made easy for buyers and sellers by the market. Financial markets develop securities products that give a return to investors and lenders who have extra money and make that money available to borrowers who need it. The stock market is one type of financial market. Financial markets are created through the buying and selling of various financial assets like shares, bonds, currencies, and derivatives. Financial markets primarily rely on informational transparency to ensure efficient and appropriate prices. The market pricing of securities might not accurately reflect their underlying value because of macroeconomic issues like taxation. While some financial markets are small and inactive, others, like the New York Stock Trade, NYSE, trade trillions of dollars worth of assets every day. The equities stock market is a type of financial market where investors can purchase and sell shares of publicly traded companies. The primary stock market is where new stock issues, also known as initial public offerings, IPOs, are exchanged. Any extra trading in stocks takes place on the secondary market, which enables investors to buy and sell shares they already own. Types of financial markets. The characteristics of the financial claims being traded and the requirements of the various market players determine the various sorts of financial markets that exist. We can distinguish between several market types according to the kind of traded instruments and their maturity. Below is the common breakdown. Stock markets. The stock market is perhaps the financial market that is most prevalent. These are places where buyers and sellers of shares that firms list can transact. Stock markets, also known as equities markets, are used by businesses to raise capital through an initial public offering, IPO, after which shares are traded between various buyers and sellers in a market known as the secondary market. Over-the-counter, OTC, and public exchanges like NASDAQ and the New York Stock Exchange, NYSE, are two places where stocks can be exchanged. Regulated stock exchanges, where the majority of stock trading occurs, are important to the economy because they provide a snapshot of the state of the economy as a whole and a source of capital gains and dividend income for investors, particularly those with retirement accounts like IRAs and 401k plans. Investors, traders, retail and institutional, market makers, MMs, and specialists who maintain liquidity and provide two-sided markets are typical players in the stock market. Brokers are impartial middlemen who help sellers and buyers complete transactions but do not have any actual stock positions. Over-the-counter markets. An over-the-counter, OTC, market is decentralized in which players transact securities without a broker, trading online rather than at physical locations. Most stock trading is conducted through exchanges, while OTC markets can handle trade in some equities, for example, smaller or riskier businesses that do not meet exchanges' listing standards. However, some derivatives markets are only OTC, which accounts for a significant portion of the financial markets. In general, OTC markets are much less regulated, less liquid, and more opaque, as are the transactions that occur there. Bond markets. A bond is an asset where an investor lends money at a fixed interest rate for a predetermined time. A bond can be viewed as an agreement outlining the loan terms and the payments between the lender and borrower. Corporations, cities, states, and other sovereign entities issue bonds to fund operations and projects. For instance, securities like notes and bills issued by the U.S. Treasury are sold on the bond market. The debt, credit, or fixed income markets are other names for the bond market. Money markets. The money markets typically deal in highly liquid, short-term securities with maturities of less than a year, and they are distinguished by a relatively low rate of interest return and a high level of safety. The money markets feature substantial volume trading between institutions and traders at the wholesale level. They include money market accounts opened by bank customers and mutual funds purchased by retail investors. People can also participate in the money markets by purchasing short-term certificates of deposit, CDs, municipal bonds, or U.S. Treasury securities. Treasury notes are one type of example. Derivatives markets. A derivative is a two or more party contract whose value is predetermined by an underlying financial instrument, like a security, or group of assets, like an index. Derivatives are secondary securities whose value is entirely determined by the value of the original security to which they are linked. A derivative has no value by itself. A derivatives market trades complex financial products like futures and options contracts, which derive their value from underlying securities like bonds, commodities, currencies, interest rates, market indices, and stocks instead of trading equities directly. Futures contracts are listed and sold on futures exchanges. The futures markets, which use standardized contract specifications, are well regulated and use clearinghouses to settle and confirm trades, unlike OTC forward markets. Like stock exchanges, options markets like the Chicago Board Options Exchange, CBOE, list and oversee options contracts. Contracts on various asset classes, including stocks, fixed income instruments, commodities, and so forth, may be listed on futures and options exchanges. Forex market. The market where participants can purchase, sell, hedge, and take risks on the exchange rates between currency pairings is known as the Forex, foreign exchange, market. The FX market is the most liquid asset globally since cash is the most liquid asset. Daily transactions on the currency market exceed $7.5 trillion, more than on the futures and stock markets. The Forex market is decentralized and comprises a global network of computers and brokers, just like the OTC markets. Banks, commercial enterprises, central banks, asset management businesses, hedge funds, small-scale currency dealers, and investors comprise the Forex market. Commodities markets. Producers and consumers exchange physical commodities such as agricultural goods, such as corn, livestock, and soybeans, energy goods, such as oil, gas, and carbon credits, precious metals, such as gold, silver, and platinum, or soft goods, such as cotton, coffee, and sugar, on commodities markets. These places, where tangible goods are traded for cash, are called spot commodity markets. However, most of these commodities trading occurs on derivatives markets, which use spot commodities as the underlying assets. All throughout the world, commodity forwards, futures, and options are traded on publicly traded exchanges like the Chicago Mercantile Exchange, CME, and the Intercontinental Exchange, ICE, as well as over-the-counter, OTC. Cryptocurrency markets. Over the past several years, cryptocurrencies, decentralized digital assets based on blockchain technology, such as Bitcoin and Ethereum, have been created and have experienced substantial growth. Today, various independent online cryptocurrency exchanges offer hundreds of cryptocurrency tokens for trading. These exchanges give traders access to digital wallets to exchange one cryptocurrency for another or fiat money like euros or dollars. Users are at risk of hacking or fraud because the bulk of cryptocurrency exchanges are centralized platforms. Decentralized exchanges are ones that function without a central authority. These exchanges allow for direct P2P, peer-to-peer, trading of digital currencies without the need for a formal exchange body to manage the transactions. Futures and options trading are also available for popular cryptocurrencies. Key participants in the market: dealers, brokers, financial intermediaries, and you and I are important financial market participants. These participants all play a different role in facilitating the flow of goods, knowledge, and capital. Financial transactions are simplified, accelerated, and made safer by the existence of these players, ultimately increasing efficiency. You might do direct financial transactions with your friends, such as buying coffee or borrowing money to see a movie. Typically, these are little purchases. However, you need sophisticated financial firms with resources, knowledge, and networks for larger or more intricate transactions. Broker markets and dealer markets are the two divisions of the secondary markets. The main distinction between broker and dealer markets is how each market executes securities trades. Dealers. Securities purchased or sold by financial dealers are their property. A dealer trades from their portfolio when they do a financial transaction. Dealers do not engage in market activity in the same way that an individual or institutional investor does, who is only trying to increase the value of their investments. Dealers instead attempt to make markets, which refers to their readiness and capacity to purchase and sell securities at the current bid and ask prices. Instead of earning money on the performance of the underlying assets, dealers instead profit from the volume of trading and the difference between their bid price, the price at which they are willing to purchase a security, and their ask price, the price at which they are willing to sell a security. Dealers improve the market's liquidity and efficiency by constantly being prepped to purchase or sell. The Securities and Exchange Commission, SEC, has governing authority over dealers in the U.S. The rapid execution of orders, acceptable pricing, and disclosure of any potential conflicts of interest with investors are all ensured by such regulatory control of the dealers. Brokers. Brokers serve as market facilitators by bringing buyers and sellers together for a transaction. Brokers differ from dealers, who make purchases and sales from their stock portfolio. Traditionally, these businesses and people are paid a commission on sales. You can deal with a budget or full-service broker in the world of stockbrokers, and the fees and costs would be very different. A discount broker carries out trades on behalf of customers. Clients must use brokers because securities exchanges need members to accept orders. Discount brokers, or platforms like Robinhood or eDeal, may not charge commissions or very low rates for many deal executions, although the exchanges may pay them fees. Additionally, they don't provide investing advice. Full-service brokers provide more services and pay more than bargain brokers. In addition to carrying out transactions, full-service brokers may provide retirement planning, portfolio management, and investment counseling. Financial intermediaries. To make transactions between parties easier and more effective, a financial intermediary, such as a commercial bank or mutual fund investment business, acts as an intermediary. For instance, a commercial bank offers loans for borrowers and takes deposits from investors and savers. An investing firm combines money from investors to affordably buy and manage stock and bond portfolios. These exchanges are different from those made by a dealer or broker. Dealers can purchase or sell from their holdings, and brokers arrange trades. Financial intermediaries, however, take money from investors and might even produce an entirely new security. You are not immediately impacted, for instance, if the borrower defaults on a mortgage loan made by the commercial bank where you have a certificate of deposit. Your investment is still safely generating interest. Typically, financial institutions support financial intermediation. However, a financial intermediary is sometimes unnecessary for lenders and borrowers to begin a transaction. When this occurs widely, a process called disintermediation occurs that can have disastrous effects on the financial markets. Inflation in the 1970s was over 10% per year, but commercial banks could only provide savings account interest rates of 5%. As a result, investors went straight to Treasury securities and other short-term marketable assets, Avoiding banks and savings and loan associations. The savings and loan sector was essentially dissolved due to the shortage of deposit funds and the industry's following actions, which resulted in considerable deregulation of investment and commercial banking in the United States. A strong network of financial intermediaries has various benefits. By decreasing transaction costs, they improve the efficiency of the financial system. To reduce financial fraud and abuse, they collect and disseminate information. They offer scale economies and expert knowledge. And finally, the operation of a capitalist economy depends on financial intermediaries. Chapter 3. Essential Tools for Day Trading. The newbie mistake of employing the wrong tools is one that many new traders commit. It's crucial to use the proper day trading tools and software. While a seasoned trader may get by with a less than ideal tool, new traders require every edge they can get. This calls for ensuring you have the best charting, scanning, and trading software available. I often discuss my attempt to ride a road bike on the sand. No matter your road bike's cost, you can't ride it on the sand. You will have a blast riding a used beach bike with fat tires that costs $200. The cyclist on the road bike will be perplexed about why you are riding more smoothly. It's because you're employing the appropriate tools for the situation. Using the proper tools is more important than spending a lot of money. Utilize the tools that will make your life the easiest for you. Choosing the right trading platform. The public continues to be drawn to and fascinated by the stock market. For greater returns, more and more people are turning to it. However, the economy is improving, which raises the price of shares. So why not profit from stock market goods? However, investors need to be aware of some risks when buying stocks. However, if you've decided to start investing and want to know what to look for in a reliable trading platform, continue reading. You can use these 6 steps to select your perfect trading platform as a new trader. Understand your needs. Before clicking on brokerage advertisements, consider the features you require from an internet trading platform. The response will vary considerably depending on your investing goals and where you are along the financial learning arc. Services like fundamental education resources, exhaustive glossaries, quick access to support staff, and the power to perform practice trades may be required before beginning with real money if you are just getting started. Avoid trying to be like others. Never choose a trading platform just because other traders recommend or use it. Always select an online trading platform per your unique needs. Choose the best trading platform for yourself by analyzing the data, consulting with your broker, and evaluating their level of competence. Friendly user interface. Look at the trading platform to see if you like the overlay. If the answer is no, you should consider alternative options. You must learn how to use any online trading platform efficiently. When you open the website, you should be able to understand the basic icons and options. Additional product offerings and features. Your ideal online trading environment should be compatible with your current trading environment. For beginners, it is typically best to start with something simpler so they can pick it up quickly. Your platform ought to give you all you need to improve. Consequently, getting a trading platform with a solid product lineup is crucial. Stable foundation. One of the most crucial elements in trading is stability. A platform's performance must be guaranteed to be reliable and effective. This is one of the most important elements of trading. Clearly outlined fee structure. Although there may be other considerations more significant than fees, you must know how much you will spend to use any trading platform. A small premium may be appropriate for some platforms that offer capabilities and offerings that their less priced competitors do not. Generally speaking, trying to lose as little of your investment gains to trading fees and bookkeeping expenses would be beneficial. With a little study, you can quickly determine which online platforms are incompatible with the type of trade you're interested in and which are too expensive to study. Other things to consider when choosing your day trading software. Most brokers offer trading software as a platform to help in their trade analysis and order execution. In essence, the software provides tools for performing both technical and fundamental analysis. The charts and other tools are provided. Additionally, it offers a communication channel between the day trader and the broker. As a result, when a trader clicks the buy or sells button, a communication channel is generated that instructs the broker to carry out the trade. As long as you are a company customer, the trading software is often free. Some platforms are even provided without cost. With MT4 and MT5, for instance, you can quickly download the program online and set up a demo account. There are several types of trading software. Others are downloadable Windows, Linux, and Mac programs, while some are mobile-only platforms. Not every system is the same. A few of them were created especially for day trading. You can make split-second decisions with the help of the capabilities provided by these systems. There are several features of a trading system to be taken into account. 1. Is the system stable? Even while many traders certainly believe speed is more crucial, the stability of a trading system is most likely the most crucial factor. Since certain systems experience prolonged downtime, stock quotations and executions must be dependable and stable. To get connected to the market and take advantage of any opportunities that may arise, you must ensure you have as much trading time as possible. 2. How fast is the system? A trading system's speed is crucial, provided it is stable. When you spot a fantastic trading opportunity, you want to be certain you can capitalize on it fully. You want to be sure you can be the first trader to execute the transaction because you won't be the only trader to see that chance. Speed is crucial for both spotting the trade and making it. So, ensure that the system you utilize is really quick. 3. Do stock charts exist in the system? To a trader, stock charts are crucial. These serve as a method of tracking previous transactions for a stock. Using a good charting application, you may perform many technical analyses on a stock. These studies will enable you to spot trends in the historical behavior of stock trading. The historical patterns of equities should help day traders identify potential trading opportunities in the future. 4. Is the customer support staff on the trading platform competent? A trader may require assistance from their platform provider for two reasons. The first is that there are always problems, regardless of how reliable a trading platform is. These problems could be with the stock market or the network that connects the trading system. A capable support group can guarantee that you are promptly informed of all the problems. A solid trading platform will include many features a trader can utilize, which is the second factor. A solid support group will be able to instruct a trader on how to use the tools and explain them to them. A trader must consider these factors when choosing a platform for day trading. Introduction to trading indicators and oscillators. The position or state of a financial asset can be determined using oscillators, which are significant indicators. The indicators, as their name implies, typically oscillate between 2 points. They are typically used to spot overbought and oversold conditions. Traders also use them to validate trends. This section will examine some of the top oscillators available for trading. MACD. Some of the best market indicators are moving averages. Day traders mostly use them to follow trends and spot market reversals. Two moving averages are transformed into an oscillator by the MACD indicator. It achieves this by deducting the longer moving average from the shorter one. The shorter moving average is typically 9, and the longer average is 26. When applied to a chart, the indicator has two flowing lines and a neutral level. There are numerous applications for the MACD. It can be used, for instance, to trade reversals. Typically, this occurs when the two moving averages cross in a bullish or bearish direction. It can be used to trade divergences as well. When an asset increases while the MACD is slowly trending lower, this is known as a divergence. As was already said, trend following is another way to employ the MACD. As long as the two lines move higher, their price will often continue to rise. RSI, or Relative Strength Index. One of the most widely used oscillators on the market is the Relative Strength Index, RSI. It is a well-known indicator produced by J. Wells Wilder a renowned expert who also developed the Average Directional Index, ADX, and the Average True Range, ATR, among other indicators. The RSI gauges how quickly and often prices change on the stock market. It is computed by determining an asset's relative strength first, then by adding 1. The total amount is then subtracted by 100, and the result is divided by 100. The RSI can be used in various ways by traders. For instance, the most common application of the indicator is to spot overbought and oversold levels. The oversold level is 30, while the basic overbought level is 70. The RSI can also be used for trend following. As long as the RSI moves upward, the asset's price will continue to rise. As long as the RSI is declining, it restarts its bearish trend. Stochastic oscillator. George Lane created the popular indicator known as the stochastic oscillator. It often displays where the close was with the high-low range for a specific period. The indicator has 2 flowing lines marked with a %K and %D symbols. Additionally, it is 80 and 20, respectively, above its overbought and oversold marks. The stochastic oscillator is most effective for day traders when a financial asset is trending or is volatile. It is relatively challenging to employ in ranging markets. Like other oscillators, for range markets, we have various strategies. Buying when it becomes severely oversold and selling when it becomes excessively overbought are 2 strategies for using the indicator. It can be used to detect divergences as well as reversals. CM, or Chand Momentum Oscillator. Another indication that is fairly well liked by traders is the Chand Momentum Oscillator. The lack of overbought and oversold levels sets it apart from the Relative Strength Index and the stochastic. Instead, it delivers the signal down a flowing line that is neutral. The indicator is determined by subtracting the closes from the total of all recent lower closes. The answer is multiplied by 100 and divided by the total price change amount. The Chand Momentum Oscillator determines when a rally or a bearish trend has reached its limit. Since it will typically continue to rise as long as the price grows, you can also utilize it in trend following. Another alternative is to utilize it to look for divergences. Commodity Channel Index, CCI. Donald Lambert created the CCI indicator in the 1970s. The commodity market was his indicator's initial area of attention. The CCI indicator is now used for trading on various markets, including bonds and equities. The indicator primarily identifies extremes or levels of overbought and oversold conditions. It compares the current price level to the overall average during the specific period. The CCI is, therefore, higher when the price is higher than its average. DeMarker Indicator. Tom DeMark created the DeMarker indicator in the 1970s. Comparatively speaking, its computation differs from other metrics. For starters, it is unconcerned with an asset's closing price. Instead, it concentrates on the highs and lows within the span. On a chart, the high and low of the most recent bar are compared to those of the bar before it. The indicator is similar to the Relative Strength Index, RSI, because it has a line and overbought and oversold values. It can be used similarly to the RSI by traders. Awesome Oscillator. A well-liked indicator that contrasts recent market fluctuations with historical market movements is called the Awesome Oscillator, AO. A sequence of green and red bars is present, along with a neutral level. Red bars indicate a price decline, while green bars indicate a price increase. The 34-period simple moving average of the median prices generates the indicator. After that, it is deducted from a 5-period SMA of price medians. Both day traders and long-term investors employ oscillators as crucial indicators. To fully utilize these indicators' potential and prevent false signals, they are advised to be used with other indicators like moving averages and Bollinger Bands. I hope you are enjoying my audiobook so far. It would be a pleasure if you could let me know how you are feeling about this audiobook in the comments section below. We would greatly appreciate it if you could also like this video and subscribe to United Audiobooks to have access to more best-selling audiobooks in the future. Also, please, if you are interested in getting more free audiobooks, please click the first link in the description below. Now, let us carry on with the next chapter. Chapter 4. Technical Analysis, Chart Patterns, and Trend Analysis. Technical analysis examines historical market data to predict upcoming price movements. Along with fundamental analysis, the methodology is regarded as a subset of security analysis. More importantly, a variety of methods and markets, such as day trading in Forex, cryptocurrencies, oil, and other commodities, might benefit from using technical analysis. Every degree of experience, from novice to expert, can use it. In this chapter, we'll look at day trading's usage of technical analysis. Technical analysis explained. Technical analysis uses a variety of charts, indicators, and other tools to analyze past market behavior and price activity to help investors identify potential trading opportunities in the future. Fundamental analysis, in contrast, can be used in both macroeconomic and microeconomic contexts. The assessment of revenues, costs, earnings, assets, liabilities, capital structure, and soft factors, quality of management team, competitive position, are all included in micro-level fundamental analysis. The study or forecasting of economic growth, inflation, credit cycles, interest rate trends, capital flows between countries, labor and resource use, and their cyclicality are all included in macro-level fundamental analysis. It also contains soft statistics, such as attitude or confidence polls, geopolitical issues, central bank and political policies and behavior, consumer and corporate trends, and demographic changes. Some traders may focus on just one, while others may use both to guide their trading and investment decisions. Today, most big banks and brokerages have fundamental and technical analysis departments. In general, one's trading outcomes are likely to be better the more high-quality information they consume to increase their chances of being correct. Technical analysts are often called chartists because they use charts showing price and volume data to spot trends and patterns when examining stocks. Support, resistance, trend lines, candlestick patterns, such as reversals, head and shoulders, moving averages, and technical indicators are a few examples of price patterns. Assumptions in technical analysis. Most traders and investors tend to fall into one camp or another, or at the very least rely on one far more heavily when making trading decisions, even though some utilize both fundamental and technical analysis. Technical analysts rely on the methodology due to two fundamental assumptions. Price, volume, and volatility typically follow separate trends, and price history tends to be cyclical. Let's examine both. Cycles and the market. Human nature is cyclical, which explains why market history often repeats itself. Even though the events don't always go in the same order, there are common patterns. They could manifest as either long or short-term pricing behavior. Business cycles are prone to repeating themselves over the long term because credit booms when debt increases unsustainably above income for a while and finally causes financial hardship when insufficient money is insufficient. This usually causes stocks and other risk-on activities, like carry trading, to rise gradually over time during an upswing and plummet precipitously during a recession. According to technicians, market players exhibit collective, predictable behavior, leading them to replicate past behavior. If a pattern is repeatable, it suggests that it can be identified by analyzing previous volume and price data and utilized to forecast future price trends. In essence, traders can find deals where the risk/reward ratio favors them if they can spot situations when behavior is likely to be repeated. As a result, technical analysis implicitly assumes that a market's price discounts all information impacting that market. Technical analysis will instead concentrate on identifying price trends and the degree to which market participants value certain information. Fundamental events, such as news and economic data, impact financial markets. For instance, by seeing how asset prices respond immediately after U.S. CPI inflation data are released that are 0.1% greater than what was anticipated by the market before the new release, we may determine how sensitive the market is to that information. We can understand how much economic inputs affect particular markets if U.S. stock futures decrease by X%, the U.S. dollar index rises by Y%, and the yield on the U.S. 10-year Treasury climbs by Z%. For stress testing as a type of risk management, awareness of certain sensitivities can be helpful. We can use data points related to unexpected inflation readings to estimate how the portfolio might be affected. For instance, if inflation unexpectedly increased by 1%. The relationship between price, volume, and volatility is divergent. Another underlying presumption of technical analysis is that price does not move in a random walk or any other discernible or logical pattern. This presumption applies to all securities analysis in general. Instead, it follows patterns that can be explained and are predictable. By examining support and resistance in the context of the trend, we can observe how the technical analysis was used by looking at a chart of the EUR/USD from mid-2013 to mid-2017. Technical analysts might have entered short bets on a retreat to resistance levels within the context of the downtrend after the euro started to depreciate against the US dollar due to a divergence in monetary policy in mid-2014. A technician might have opted to play the range once the trend faded and the market entered a period of consolidation and began taking long bets at support levels while closing any open short positions. Analytical approaches. Technical analysis can be approached in a variety of ways. The simplest technique is to use a standard candlestick price chart, which displays price dynamics over time and buying and selling trends. Other investors utilize a price chart with technical indicators or more specialist technical analysis techniques like harmonics or Elliott wave theory for trading ideas. Some people combine elements of numerous techniques. The idea of information overload, cluttering charts with too many indicators and lines, must be avoided by traders to preserve their ability to interpret charts. To increase the objectivity of their trading and prevent emotional biases from impairing its performance, others may only engage in trades when a set of rules uniformly apply. Types of charts. Candlestick. The most prevalent type of charting in today's software is candlestick charts. Bullish candles are typically represented by green, or occasionally white, ones when the current price exceeds the starting price. For bearish candles, where the current price is lower than the opening price, red, or occasionally black, is common. It displays the difference between the high and low prices, the candle's body, and the overall daily range, the wick's top and bottom. Open, high, low, close. A candlestick chart resembles a bar chart, often an open, high, low, close chart. Instead, horizontal tick marks indicate the price difference between the open and close. The other price tick points to the right, whereas the opening price tick points left, to indicate that it originated in the past. Candlestick charts are especially well liked by novice traders just getting started with technical analysis. Line. A line connecting the data points on a line chart is typically drawn from the closing price for each period. Area. An area chart is a line chart with the region beneath it colored. By doing this, the price movement concerning a line chart can be seen. Heikin-Ashi. Candlesticks are used as the plotting medium in Heikin-Ashi charts, but a separate mathematical definition of price is used. Prices are smoothed to better depict trending market movement in place of the conventional technique of candles translated from fundamental open, high, low, close criteria. Open of previous bar plus previous bar's close divided by 2 equals open. Open plus high plus low plus close divided by 4 equals close. Highest of high, open, or close equals high. Lowest of low, open, or close equals low. Trading charts can evaluate periods ranging from 1 minute to 1 hour or even 8 hours, depending on the objectives. Forex traders are particularly fond of the 8-hour time frame. Recognizing support and resistance levels. To trade on the financial market, traders employ a variety of strategies. One of the most popular day trading tactics is pattern recognition. Additionally, using support and resistance well will benefit you greatly. Earlier in this chapter, we covered the feature of technical analysis. Price action entails precisely this, looking at charts and identifying patterns, and is another popular trading strategy. And guess what else is a common element of price action and technical analysis? Yes, both resistance and support are used. Here, we'll examine this approach's definition and practical applications. What is support and resistance? Traders in the financial market look for patterns to predict future events and find plenty of patterns to look for. For instance, they use candlestick patterns like the evening, morning, and doji to forecast future events. The levels of support and resistance are ones that a financial asset finds challenging to cross. A level of demand deemed so strong that it keeps a price from falling below is referred to as support. A currency or other financial asset may find it difficult to travel through it. The reasoning behind this is straightforward. When the price of an asset declines, buyers are more likely to buy, and sellers are more likely to sell. It is believed that supply will be surpassed by demand when the price reaches the support level. A support level is the opposite of a resistance level. To stop the price from rising, selling is expected to be particularly vigorous at this point. It is believed that sellers will be more motivated to sell, and buyers will be less inclined to buy as the price rises toward the resistance. It is believed that a resistance level acts as a ceiling. S and R levels. How to draw them. Several methods exist for determining support and resistance levels. The strategy presented above is the most fundamental. Connect the high and low levels with a line. These layers can be drawn diagonally or horizontally. Another strategy is to consider psychological levels, and we are all aware of the significant influence of psychology on traders. These are points that are very important to traders. For instance, levels with round numbers are a trader's favorite. Using Fibonacci retracement. Utilizing the Fibonacci retracement tool is another method of determining support and resistance levels. Simply connecting an asset's highest and lowest levels will create the tool. The critical levels of the retracement will be the support and resistance levels after connecting these points. Psychological numbers. Finally, psychological numbers can be used as yet another method of identifying support and resistance. For instance, if a stock has increased from $150 to $180, $190, and $200 will be the next important resistance levels. Due to how memorable they are, these levels are typically strong. Additionally, it's common for traders to set their take profit and stop loss levels there. Day trading with support and resistance. There are numerous ways to apply S and R. Trading via a channel is the best course of action. When the asset reaches the support level, the goal is to purchase. When it reaches the resistance level, you are short. This approach performs admirably. But you must watch out for a breakout. A breakout occurs when the price rises over the support and resistance levels. When it occurs on support, bears have won the battle. This does not imply that the price will keep advancing in the breakout direction. When this happens, it is referred to be a false breakout. Strategies for support and resistance. Stops. Another strategy is utilizing support and resistance levels to place a stop loss and take profit. A stop loss is a point at which you intend to sustain the greatest loss. Every professional day trader needs a take profit and stop loss order. What occurred in the cryptocurrency sector in May 2021 is a fantastic illustration. The values of most cryptocurrencies fell precipitously after rising to an all-time high. In this instance, traders who did not have a take profit or a stop loss suffered significant losses. The use of pending orders. Using pending orders is another well-liked trading strategy when using support and resistance. To begin with, a pending order is when you instruct a broker to buy or sell an item at a later date. For instance, if an Apple stock established firm support at $116 and resistance at $135, Predicting whether the stock price will go above or below the barrier is difficult. You might then set a buy stop trade at $137 and a sell stop trade at $114. In this instance, the stock will advance to $137 and a new trade will be opened if it breaks higher. Similarly, a short order will be traded if it drops below $116. As a result, in this instance, you found good entry points using support and resistance levels. Pending orders are also significant because they are only opened when the price tests them. Chapter 5. Risk Management Strategies. The success of your day trading endeavors will only depend on your capacity for risk management. The secret to your success will be a business plan to earn money, regardless of whether you want to use a discretionary or systematic method. Choosing your financial risk tolerance is the most effective method for the process. Developing a plan. You should treat day trading like a business. Before you begin, you must know the investment funds you intend to devote to your day trading operations. Although this might change in the future, you must start somewhere. One of your portfolio's many varied investing techniques that you should allocate is day trading. Furthermore, the money you use for day trading should be discretionary rather than going toward necessities like food and shelter. After allocating funds to your day trading activities, you can try to decide whether you'll employ one trading strategy or several to generate profits. Paid to take risks. You are paid to take chances. Keep this in mind. Your financial objective when day trading is to earn a premium over the risk-free rate of return. The amount you can earn without taking risks is the risk-free rate. A U.S. Treasury bill serves as an example. You will receive the return stated and have the full confidence of the United States government as your borrower if you hold a 1-month bill for the entire month. You should consider a few things when deciding how much money to set up for your day trading activity. Allocating your capital. Will you only use one day trading technique with all of your funds? Or would you think about using several strategies? Will you use purely optional strategies? Or just automatic and systematic? Will you be the only one to trade on your account? Or do you intend to delegate money management to someone else? The fundamental guideline is to avoid putting all your eggs in one basket. Diversification is a theoretical idea. According to this theory, diversifying your investment portfolio reduces the likelihood that one method will fail and force you to stop day trading. Therefore, you are more likely to have a successful day trading experience if you have 3 profitable strategies and 1 losing one. Risk management for different strategies. Day trading strategies can be divided into 2 primary categories: discretionary and systematic/automated. Additionally, you can mix the two. You can ignore signs that typically result in a trading opportunity when using a discretionary method. A systematic strategy entails entering a transaction when a signal is detected and automatically managing risk based on established criteria. Strategies for discretionary day trading. Before you place your trade, you should lay out your risk management strategy if you intend to employ discretion. Although applying the same risk-to-reward strategy to every deal is unnecessary, doing so can be beneficial. Risk management for systematic day traders. Avoiding overriding a trade alert is part of a systematic approach to day trading. Employing this strategy removes some human factors that could hinder the strategy's success. A systematic approach's risk management can be back-tested to see if it was successful in the past. The use of a systematic approach has various advantages. Back-testing a sample of data can provide you the assurance you need to put a trading strategy into action. When you are confident in a day trading strategy that has been back-tested, make sure to test it using real-time data before you start to stake real money in it. Additionally, you might want to think about establishing a paper trading account to test the approach and ensure success. How to measure risk. Risk is the amount of funds you could lose in a trade. It isn't the actual loss. Rather, it's what might have been the actual loss. By deciding how much you are willing to lose, you can assess loss more accurately. You should know where to exit the trade using a stop loss and take profit levels before you place your transaction. You will reduce your risk just by going through this method. Traders who don't create a plan will encounter unforeseen circumstances and won't have a plan for handling them. Your risk should depend on the results of your approach. Different types of strategy returns. To achieve consistent profits, you must win more transactions than you lose, or gain more on winning transactions than you lose on losing trades. The amount you gain may be equal to or slightly less than the amount you lose if your business makes more money than it loses. In contrast, if the strategy you intend to use will produce more losers than winners, the profit from successful transactions may exceed the loss from unsuccessful trades. This is the math. Assume for this discussion that you intend to execute 9 trades daily in all the securities you would trade. If you win more often than you lose, you can afford to win $100, $500 for 5 winnings, minus $400 for 4 losers, for a profitable approach. On the other hand, if you lose more than you win throughout the same 9 trades, you will need to win more than you lose on each trade to be profitable. 4 winners at $200 each equals $800, minus 5 losers at $150 each equals $750. This strategy can be used to create a reward-to-risk ratio. This will let you assess the long-term viability of your idea. If your risk management strategy does not result in a financially viable strategy, you must adjust the plan until you find one that does. Here are a few strategies. The accurate stop-loss and take-profit levels can be determined in several ways to create a risk management strategy. Day trading aims to close out holdings before the day is out. This implies that you need to be aware of the daily movement of each security you intend to trade. Determining the product's daily volatility can be your first step in trading. This can help you understand how much money you expect to make or lose each day on average. You can perform your calculations or look them up online. You can search for the amount in pips or percentage if trading Forex. The volatility in stock trading may be expressed in dollars. Choosing a stop-loss. Formulating your stop-loss level is a good start when figuring out your return-to-risk ratio. You could set your stop-loss level at 1% for each trade. Alternately, it might be below a particular chart point trigger or a financial threshold. One of the easier computations is the return as a percentage. Identifying the viability of your trading strategy should be your first step. Backtesting is the most efficient way to achieve this. Even manually, you can check to see if it has previously worked. Real-time testing of your strategy would be the next stage. Instead of a percentage, you can substitute a dollar amount and still utilize the same procedure. Making use of technical analysis. Many traders often utilize technical analysis to decide where to enter or leave a position by using support and resistance levels. You can think about employing trend lines or moving averages to locate support and resistance levels to help you choose the ideal place to take profits and establish stop losses. A trader might short sell gold, setting a stop loss at the 50-period moving average and take a profit at an ascending trend line. Consider using a momentum oscillator in your trading, like the Relative Strength Index, RSI, which generates overbought and oversold levels. As your risk management triggers, this might function in concert with support and resistance levels. As an illustration, you can purchase when the RSI enters the oversold zone and profit when it reaches the 50-period moving average. An upward or horizontal trend line could serve as your stop loss. Another option is to use a Bollinger Band approach. Bollinger Bands use volatility, the standard deviation, to establish the most recent range. For intraday data, you can modify the Bollinger Bands, which could help you determine your take profit and stop loss levels. Finally, you must create a risk management strategy to trade the markets successfully. Before making a deal, you should have a plan in place. Day trading involves risks, but the potential rewards should outweigh those risks. Utilizing numerous day trading strategies is one approach to preventing one day trading strategy from destroying your entire day trading operation. Your chance of ruin will be reduced with the aid of this diversification. Additionally, there are various definitions for risk management. You can employ simple techniques like the percentage of a trade's gain or loss. You can also employ technical analysis strategies to determine your entry and exit points. Make a risk/reward calculation before you begin trading. This will enable you to assess your financial objectives concerning the risk you will take. Remember that you are compensated for taking risks above the return on risk. You must realize that not every trade will succeed. You are trying to develop a strategy that will adhere to your risk management plan and enable you to develop a profitable day trading approach. Chapter 6: Day Trading Strategies for Stocks and ETFs. You can trade various financial instruments on the market. Stocks, commodities, bonds, and exchange-traded funds, ETFs, are crucial assets. What and how to trade depends on your trading goals and style. However, nothing is stopping you from diversifying your investments. This chapter will examine ETFs and stocks in depth, including what they are and how to trade them profitably. Day trading ETFs. Here, we'll discuss how day trading ETFs can help you quickly increase a small account. ETFs can be one of the greatest and safest ways to continuously profit from the financial markets when used with the appropriate approach. ETFs are flexible financial tools that work with all trading philosophies. This implies that you can start trading ETFs, whether day or swing. You can reap some benefits of ETF trading by managing the risk involved. We will discuss the advantages of including ETFs in your trading and investment portfolio. However, we will also discuss the risks of ETFs, exchange-traded funds. We believe that this ETF step-by-step guide will be helpful if you are unfamiliar with ETF trading or don't fully grasp how to trade ETFs. What is ETFs trading? Exchange-traded funds, ETFs, are financial products traded on U.S. stock exchanges and created to track the price of a certain basket of assets. Trading ETFs functions precisely like trading stocks. Some of the best qualities offered by equities and mutual funds are consolidated in ETFs. Most ETFs trade on exchanges in shares similar to stocks and aim to track a benchmark index. Every significant asset class has an ETF, including stocks, bonds, commodities, and cash. For instance, the SPDR S&P 500 ETF, SPY, tracks the S&P 500 index. ETFs offer a more affordable way to gain exposure to a market that would otherwise be very challenging to trade. As an illustration, a trader has several additional options to invest in gold. He can purchase gold coins, bullion bars, or futures contracts. However, these are challenging, time-consuming, and expensive means of buying gold. Joe's cheapest and most straightforward choice is to purchase shares of a gold exchange-traded fund, or ETF, like GLD, which tracks the price of gold. Joe can complete this task faster and for a lot less money. If the stock market increases, you can purchase a stock index like Dow Jones. Either purchase all 30 firms that make up the Dow Jones Index, which can be very expensive, or purchase DJIA futures contracts. Purchase shares in an ETF that tracks Dow Jones, such as the DIA ETF, if you wish to do this for a much lower cost. ETFs are ideal for day trading due to their high level of volatility. Next, we'd like to explain how day trading ETFs work. Day trading ETFs. Due to the extreme volatility of this market, day trading is one of the greatest ETF trading strategies. This indicates that you can buy and sell ETFs anytime during trading. There are several exchange-traded funds, ETFs, but the best ETFs for day trading are the iShares MSCI Emerging Markets ETF, EEM, ProShares VIX Short-Term Futures ETF, VIXY, Gold Miners ETF, GDX, and ProShares VIX Short-Term Futures ETF, VIXY. These ETFs rank among the top 5 most traded ones in the US. You can find incredibly lucrative short-term possibilities using an ETF, exchange-traded fund. However, the likelihood of making any money by day trading ETFs is quite slim. For this reason, you must adhere to a few restrictions when playing the game. Before we continue, We always advise getting out some paper and a pen to write down the guidelines for trading ETFs. In this part, we'll examine the purchasing process for ETFs. Step 1. Select the correct ETF to day trade. The most well-known and the first ETF, exchange-traded fund, to be listed on the U.S. market is the SPY ETF, or SPDR S&P 500 ETF. Because SPY ranks for the most AUM and has the highest trading volume, we enjoy day trading it. The S&P 500, the most well-liked stock index in the world, is tracked by the SPY ETF. These are sufficient justifications for us to select SPY ETF as the best option for our day trading ETF method. Contrary to popular belief, not all exchange-traded funds are created equal. If you're unsure which one to trade, stick with the SPY ETF, which has the most credibility. We will now discuss the day trading guidelines you must follow to trade the SPY profitably. Step 2. Apply the 50-period moving average. One of the most widely used indicators in stock trading is the 50-period moving average. Many seasoned traders and investors use the 50 MA as a psychological benchmark to assess market sentiment. The 50 moving average has greater significance to the price movement because traders often use it. For this reason, we combine the 50 MA with the opening trading range. Let's see how the 50 MA and the opening trading range can be combined. Step 3. Only enter trades after 10 o'clock a.m. ET. We prefer to concentrate on the initial trading range when day trading ETFs. The biggest volume occurs during the AM session because smart money often enters the market. We can avoid spending the entire day staring at the chart by concentrating solely on the early session and only trading with institutional money. The SPDR S&P 500 Trust's regular trading hours begin at 9:30 a.m. ET. However, we like to wait and see what the smart money is doing during the first 30 minutes following the opening. Taking advantage of these opportunities during the most volatile part of the trading day is the key to successful day trading leveraged ETFs. Step 4. The price must remain above the 50 MA and open inside the previous 5-day trading range. We seek the price to hold above the important 50 moving average after examining how the market behaves throughout the first 30 minutes of the opening session. A second requirement is that the SPDR S&P 500 ETF open in the upper half of the prior 5-day trading range. Mark the highest price of that trading range together with the previous 5 trading days on your chart. It is safe to purchase SPY if, on the 6th day, we open close to the highest price and maintain a position above the 50 MA. This takes us to the next crucial decision when day trading ETFs: where to put our stop-loss protection. Step 5. Lower your stop-loss by 25 cents from the 50 moving average. The stop-loss for this automated day trading method is set at 25 cents below the 50 moving average. The bulls are quite weak if SPY breaks below the 50 MA after the open. This technical reading, in our opinion, is crucial for day trading. Among other things, we must specify where we take our profits. Step 6. Take profit if SPY advances $1. This trade idea is based on our experience that there is a very strong possibility that the SPY ETF will increase by at least $1 if all the conditions above are met. If your profit target is unmet by 4 o'clock p.m. ET, manually close the position. Day trading ETFs offer straightforward investing options and are less expensive than most financial instruments. If you want to profit from intraday volatility, don't discount the potential of trading leveraged ETFs. Day trading stocks. Day trading stocks involves speculating on stock prices within a single trading day. A stock day trader tries to make money from the brief ups and downs in a company's share price. Day traders typically hold positions for a few minutes to a few hours, rarely more than a day, as their trading approach is short-term. Why day trade stocks? Thousands of stocks are available for trading, which almost constantly represents trading chances. Many people may already be aware of what is happening with a stock, like Apple or Tesla, and will attempt to utilize that knowledge to predict the direction of the stock's price. The main goal of day trading stocks is to try to make money on betting on the price movement of a company's stock. This does not imply that it is simple. It is perhaps one of the most difficult strategies to trade stocks. Finding quality day trading stocks. Even if there are numerous strategies to day trade stocks, some traits may be shared by all day traders. Determining what works for you is crucial because each trader will have a different strategy. However, most day traders will examine several factors to find good day trading stocks. This includes news, volatility, and liquidity. 1. Volatility. High volatility may scare many long-term investors since sharp price swings can result in significant variances in profit or loss. High volatility is crucial for day traders, though, as they try to make bets on the significant price fluctuations that might occur at such periods. Traders can bet on price direction and potentially earn from rising and falling markets using products like CFDs or contracts for difference. A market heat map is accessible through Admirals and can be used to find the top movers for today, the past 24 hours, and yesterday. High volatility stocks are better for day traders since they can move more during trading. Low volatility stocks and stocks with little daily movement might be challenging for day traders. This is because day traders are battling the costs of trading, such as the spread and commissions, while simultaneously trying to profit from market moves during the day. The potential profit increases in direct proportion to a stock's movement. 2. Liquidity. The capacity to quickly and easily enter and exit a position is a stock's liquidity. A high volume or liquidity stock indicates that more buyers and sellers are interested in it. Lower spreads, the gap between the price someone is ready to buy or sell at, are another benefit of more buyers and sellers participating in a stock. Well-known stocks like Amazon and Tesla typically have larger volumes and smaller spreads since they are often traded. Traders might choose to exclude equities with a volume of at least 1 million shares per day from their search results. 3. News. News can also have a big impact on the volume and liquidity of a stock. Due to the potential for important price movements, many day traders may try to time their trades to coincide with earnings releases. This unanticipated volatility may result in your trade reaching your stop loss sooner. Prices may trade past your stop loss if they move that quickly, which would mean a bigger loss. When trying to trade around news and profits, it's crucial to keep risk to a minimum because there's a chance you could lose all of your money. What time of day is best for stock trading? The stock market is not open 24 hours a day like the currency market, which is an important distinction to remember. This implies that the stock market may fluctuate most at particular hours of the day. To modify, leave, or enter a position before the stock market shuts for the night, traders and investors may need to act as soon as the stock is available for trading. The market may have smaller price movements throughout the trading day, but trading is still permitted. Strategies for day trading stocks. There are various day trading stock strategies. This includes trend trading. Identifying a stock's trend and solely trading in that direction is known as trend trading. Breakout trading. This is the technique of spotting a period when a stock price has fluctuated and then trading the price as it crosses this range. News trading. This involves trading event-driven price action from unexpected news announcements, which produce the most volatility. Gap trading. Trading the market after it has gapped depends on whether the gap represents a continuation of the trend or an exhaustion gap. Let's examine the top 2 categories of day trading strategies. 1. Day trading stock trends. The moving average is a frequently employed strategy for determining a market's trend. This displays the market's average price over a while. In addition to providing regions of support and resistance where the price may shift, this can help in smoothing out price data to help identify the general trend. You might have noticed that the price bounced off or broke through the EMA during this period. The ensuing price swings have been quite small or extremely substantial when the price has bounced off. Day traders can use this as a springboard when developing a strategy. Many day traders can increase the number of indicators and price action patterns to find additional hints about the potential appearance of buyers or sellers. You must analyze and process as much information as possible to increase your chances of success. But even so, there will be lost transactions, so manage your risk wisely. 2. Breakouts in day trading stocks. Every day, market conditions change. Days can fluctuate from being heavily trend-based and heavily range-based. When day trading on shorter timescales, these situations are increasingly common. A stock may move in a sideways range when it is not trending. A trading range, or consolidation, is the price movement between an upper horizontal resistance line and a lower horizontal support line. Day traders could use these ranges to try to trade a breakout. Day traders could try to trade the price when it emerges from the consolidation, typically moving in the direction of the trend that came before it. Traders could wait for a bar to close outside of the trading range first to prevent false breakouts. Lastly, setting the stop loss and take profit levels is difficult. This analysis may make use of further resources. Finding swing highs and lows for stop loss placements and higher period support and resistance levels for goals are two examples of how to do this. First, it is advisable to day trade stocks on a practice account to hone your skills and gain expertise. Developing coping mechanisms for handling win and loss-related emotions is more crucial. Chapter 7. Day Trading Strategies for Forex, Options, Futures, and Cryptocurrency. Opening and closing positions during the trading day are part of day trading. It is a well-liked trading strategy where you purchase and sell over a single trading day to benefit from minute price changes. Another short-term trading strategy is day trading, but unlike scalping, you normally only take one deal each day and close it out at the end of the day. These traders enjoy choosing a side at the start of the day, operating per their bias, and then capping the day with a win or a loss. They hate keeping their trades open overnight. Forex traders with ample time throughout the day to evaluate, execute, and monitor a trade are most suited for day trading. Most of the time, day traders base their trading decisions on technical analysis. Short-term price action is monitored to find the best entry and exit positions. Day trading may be for you if you feel that swing trading is too slow and scalping is too fast. Forex day trading strategies. Trend trading strategies. The majority of new traders use trend trading strategies. As markets move in line with dominant trends 80% of the time, looking for trading opportunities in that direction is typically seen as the easiest and most dependable strategy. When using trend trading techniques, the trader looks for sudden changes and trades in significant quantities that move in the trend's direction. The trend is your friend, as the phrase goes. Since intraday trading is sometimes cited as the quickest way to profit from the stock market, it has attracted much attention recently. The fact that this particular trading strategy is complex and necessitates ongoing market monitoring is something that most recommendations neglect to highlight. Although it has a high level of risk and is not appropriate for all traders, day trading Forex may be extremely profitable. Counter-trend trading strategies. The widespread consensus is that counter trading is a more sophisticated trading strategy best suited for seasoned traders. The trader would need to predict the end of the present trend and have the timing and disposition to benefit from the trend change to execute the counter-trend trading strategies successfully. A counter-trend trader must be highly accurate at spotting temporary shifts in trend direction and forecasting the magnitude of the resulting movement. Trading against the trend involves technical analysis, price movement expertise, and experience. Forex day traders interested in testing out these trading strategies can become familiar with the fundamentals of counter trading by using a demo account or trading simulator. They can develop their skills in a risk-free environment. Day trading options. The practice of day trading options is fairly common. Trades for weekly options contracts take place here. They watch for the ideal opportunity and profit from a stock's recent trend. Day trading options involve buying short-term weekly options contracts and selling them the same day, often within a few seconds to a few minutes. Most of the time, traders purchase contracts for the final week or two before expiration, either at the money or with one strike in the money. Due to the lower prices, customers often purchase products with a same-day expiration. It's crucial to have strong volume, liquidity, narrow spreads, and significant open interest when day trading options. Moving on is essential if they don't meet that requirement. Reviewing ATR, average true range, before making the trade is also beneficial. Breakdown. When you buy an option, you can buy or sell a security at a certain striking price, stock price, but you do not have to. This indicates that you can purchase 100 shares of the stock underlying the options contract. You can't hang on to options contracts indefinitely because they expire. Because we are simply tossing them around like a hot potato, we don't give a damn about that stuff. Or similar to a musical chairs game. Soon, you'll be able to see how this parallel applies. We often day trade two different options strategies. They are naked puts and calls. If you think the stock will increase, you buy a call. If you think it will decrease, you buy a put. When the stock price changes in the direction of your call or put, you profit. This is beneficial for day trading. The naked component indicates that you are only purchasing a call or put contract and do not already own any shares of the stock at the time of purchase. So, you enter the market and trade the contract like any other stock. Selecting the appropriate strike price. You must choose a strike price and expiration date for day trading options strategies to put yourself in a profit zone when the stock moves. It is typically less expensive to choose an expiration date close to the day of the month you are trading than one a week or two away. That does not necessarily mean that is the expiration date you should be trading, though. Additionally, you'll have to decide if you want to be in or out of the money. You can utilize an options chart, such as one from Thinkorswim or Interactive Brokers, to help you in trading calls and puts. Most brokers provide a call and put chart that displays the option's performance on a candlestick chart. These are excellent platforms for practicing option paper trading. ITM options trading. A call option is in the money if the strike price is not more than the market price. If the strike price of a put option is more than the market price, the option is in the money. Being out of the money is when the put option's strike price is less than the market price and the call option's strike price is higher. For day trading, choosing a strike is crucial. More on it later. Finding the day's trend, support, and resistance is the first step in day trading options. The trend is your friend, and the option you select will depend on the trend you observe. It also helps determine the strike price you desire on that particular day. Both opposition and support are crucial. If you're purchasing a call, purchase at the support and sell at the resistance. If you are purchasing a put, you should buy at resistance and sell at support. In the previous chapter, we discussed drawing trend lines or identifying support and resistance. Daytime options trading and volatility. Picking a volatile stock is something else we advise when learning how to day trade options for income. Not a stock that is trading sideways, but one that is moving. Because options prices can depreciate quickly, day trading options differ from day trading stocks. Due to the time value function of the option, theta, options are deteriorating assets. Even a 10 or 20 cent movement can be profitable for a stock. You will profit more from options the more the stock goes in the money or into the money. The greater range a stock has, typically, the more opportunity options traders have to trade it. This is because it moves dollars each day rather than pennies. That's not to say a stock with a lower price won't make money. However, you would probably need to buy more options contracts for it to do so. The ATR is vital. I watch a few more expensive equities daily because they often move at least $5. A higher stock's risk is that its strike price is higher than that of a stock with a lower price. You must be prepared to put up the cash and accept the possibility of losing it. A scanning tool is a terrific approach to locate the stocks with an ATR, true average range, of 3 or more that we love to trade options on. If you have a margin account, you are finished for the week after reaching the PDT rule's maximum number of trades you are permitted to execute. However, since you have a cash balance, you can day trade continuously until you run out of money. You can repeat the process once your money has settled overnight, T1, weekly, 5 days. Therefore, if you only trade options and have $5,000 in your account, you can trade with $5,000 until your buying power runs out. The following day, you can repeat the process. Set goals. Options day trading can be quite profitable in a short amount of time. It is, therefore, something you can do to make money. You should first decide how much money you want to make that week or month. Next, test your skills in a practice account before using actual money. You can learn what you need to do to accomplish your goals and what mistakes you make that prevent you from achieving them by writing them down. Pick apart why things went wrong when they do so that there is a steady flow of money. There will be days when you succeed, perhaps even greater. Likewise, losing days. Quickly cutting your losses reduces any harm to your brokerage account. Protecting your capital is always a good idea. Trade defensively. Trading market open. As far as we can tell, stock prices are most erratic right before the open. However, you should wait a few minutes before diving in. They must first define their direction and momentum. We have often bought a stock because it appeared to be moving in one direction, only to turn around and move in the opposite direction for the rest of the day. If it's one of those erratic stocks, you can typically trade in and out during the day without adhering to the annoying PDT regulation. Alternatively, you can wait for it to determine its course, jump in, and ride it out until you feel it can no longer go any further. This is our preferred method. Next, create your trend lines and channels to determine when to take a profit. This is because trading credit spreads have a larger chance of success than trading naked options. Since you are selling options, the trading chances are to your advantage. As a result, you will receive less premium as you build more transactions with better likelihood. You can also make significant gains with debit spreads. They are between selling credit spreads and buying naked calls and puts. They involve a combination of purchasing and selling calls or puts when buying. Your overall risk in the trade is reduced thanks to the selling portion of the debit spread's break-even level. Strategies for futures and cryptocurrency markets. To start trading cryptocurrencies, you need to have some of your chosen currency, like Bitcoin, and the capacity to exchange it. The quickest approach for you to get started is to register an account with one of the top centralized cryptocurrency exchanges, such as Binance or Coinbase, add funds to your account in fiat currency, and then buy the currency of your choice. From there, you can start day trading cryptocurrency using one of the strategies listed below. Day trading strategies for Bitcoin. Trading differs from gambling thanks to an effective strategy. A smart strategy can tell the difference between a few unlucky runs and consistent long-term gains. You can employ a variety of trading strategies in various situations depending on the market and your skills. You must understand the market and determine when a strategy should be used. Here are a few cryptocurrency trading strategies you can utilize to learn more about day trading cryptocurrency. Arbitrage. Arbitrage occurs when a trader buys a cryptocurrency on one exchange and instantly sells it on another for a higher price. Cryptocurrency pairs may facilitate arbitrage opportunities. When the price of a crypto pair, such as Bitcoin and a lesser-known altcoin, fluctuates, arbitrageurs can make money by seizing the opportunity of price disparities across exchanges. Despite being a sophisticated financial mechanism that is often automated by price monitoring software, arbitrage preserves the stability of digital asset prices across many exchanges. Trading bot. An automated software tool called a trading bot is used by investors to buy and sell financial instruments at particular times or when conditions are satisfied to maximize earnings. Bots for cryptocurrency trading are intended to boost gains while lowering risks and losses. Trading bots for cryptocurrencies can expedite the process of evaluating price movements, exchange fees, and trading opportunities that might produce quick profits. For many years, brokerages that engage in stock exchange trading have relied heavily on trading bot software. Traders familiar with software programming and APIs should consider utilizing this as a day trader. Long straddle. The purchase of a put and call order constitutes a long straddle, occasionally referred to as a buy, option, or just straddle. The call uses the same cryptocurrency, striking price, and expiration date, putting orders in a long straddle. Due to the cryptocurrency market's volatility, the long straddle is a common trading strategy. By employing this strategy, a day trader in cryptocurrencies bets on the direction of an asset's price. The day trader still gets money whether the price of the long straddle increases or drops. If the price stays the same, the trader will incur a loss. High-frequency trading, HFT. Profiting from price changes that occur on the order of seconds or fractions of seconds is possible with high-frequency trading. The frequency in question, which is often on the order of dozens of trades per second, is inconceivable for a human trader to manage. High-frequency trading can only be done with the use of computer software known as a trading bot. The bot continuously executes transactions based on the specified trading logic and maintains an eye on the markets as long as it is connected to the exchange. By using specific trade logic, high-frequency trading can be connected with a variety of various strategies. Scalping. Scalping is a trading strategy that produces incremental earnings from a number of small deals, resulting in a larger profit. Scalping uses a lot of liquidity, money, to profit from small price variations over a brief period. The time horizon might be as short as a few seconds or as extended as a few hours. However, it is often a few minutes. Range trading. Range trading is predicated on the idea that, typically, during a given period, cryptocurrency values will only fluctuate within a specific range. Price variation outside of that range is thought to signal an impending anomalous shift in price. For instance, selling might be a good idea if the price falls under the lower bound of the range, since that would indicate the beginning of a large downward movement. Technical analysis. Statistical trading is based on technical analysis. You try to find market patterns by applying statistical computations to historical pricing data. Technical trading is predicated on the concept that past prices have some bearing on what prices will be in the future. Sentiment analysis and news. With one significant exception, news and sentiment analysis is similar to technical analysis in predicting human behavior and reactions rather than price patterns. By examining several information sources, news and sentiment analysis tries to forecast if demand for a specific cryptocurrency will decrease or increase. By analyzing the sources, you try to comprehend the societal consensus surrounding that money and predict what people will do. These numbers are taken from posts on social media and stories that were published in trade and mainstream media. Conclusion. Understanding day trading is challenging. Time, skill, and discipline are all necessary. Many people who try it lose money. However, the approaches and strategies mentioned above can help you develop a strategy that could be profitable. Individual and institutional day traders contribute significantly to the market by maintaining efficiency and liquidity. You might be able to increase your odds of trading profitably with enough experience, skill development, and regular performance evaluation. This book gives you a decent introduction to the day trading world. But it's only an introduction, nothing more. Don't expect to read this and immediately invest in the markets daily. Learning day trading won't take you a day or a week. Even the most successful traders must commit to learning throughout their entire lives. You are fortunate to have access to a wealth of resources to learn how to trade the markets. Numerous strategies have been created over time and disseminated through books and seminars, allowing you to become familiar with various approaches before settling on one. Introduction. Are you a new investor who just got started? Want to master the art of options trading but lack any prior knowledge? If so, then you should read this book. You must venture beyond basic transactions and limited stock and exchange-traded fund (ETF) purchases if you wish to succeed in the stock market. If you know what you're getting into and how to practice options trading successfully, options trading can provide a path to significant stock market success. Options are financial derivatives that offer the holder the right, but not the obligations, to purchase or sell an underlying asset at a particular price, known as the striking price, on or before a given date, known as the expiration date. At this time, the option is valid. Options are flexible financial tools that can be utilized for income generation, hedging, and speculating. Investors often employ them to reduce risk and increase returns. This book is intended to introduce options thoroughly and how they work, covering the many types of options, how to buy and sell them, and how to utilize them in different strategies. This book will help you learn the basics of options and how to utilize them effectively in your financial portfolio, whether a novice or a seasoned investor. You will get knowledge about several trading strategies to use as well as some potential dangers. When you finish reading this book, you'll have a solid foundational understanding of options trading and whether it fits you. Chapter 1: Introduction to Option Trading. You're not the only one if you've recently joined the options trading bandwagon. In fact, with 7.47 billion contracts exchanged in 2020, the popularity of trading in options, or contracts that let you wager on which way you believe a stock price is headed, reached a record high. The Options Clearing Corporation reports a 52.4% rise from the previous year. Options trading is rapidly expanding as both experienced and novice investors embrace it. These two groups are starting to understand the freedom options offer. Investors can lock in a stock price without acquiring it. Trading options can greatly increase your income, reduce your risk, and protect yourself from market volatility. Options can complement stocks in your portfolio for these reasons. Investors have more options when they trade both than when they trade equities alone. Options can function almost like an insurance policy. For instance, buying specific options might help offset any possible losses on your shares if the value of a company you hold declines. Options may allow you to change your strategy without selling your stock, lower your break-even point, and even establish a purchase price for a stock below its current market value. Despite its widespread appeal, options trading is not that simple, and getting started requires a lot of forethought. We break down below what active investors need to understand before trying options. What are options? An option is a contract that grants you the right to purchase or sell a financial product for a predetermined amount of time at the agreed-upon price. Equities, indexes, and ETFs are just a few financial products with options available. Options are referred to as derivatives because their value is derived from the underlying asset. You trade ownership in a corporation when you trade stocks. In contrast, the possibility or obligation to buy or sell the underlying stock is traded when options contracts are bought or sold. The mere possession of an option does not grant the holder ownership of the underlying securities or any dividend rights. Why trade options? Options have been available for more than 40 years, but they have only begun to receive the attention they merit. Many investors have ignored options because they are too complex and difficult to understand. Because neither they nor their brokers received adequate training on utilizing options, many more people have had initial negative experiences with them. Like any strong tool, options can be misused to cause serious issues. Finally, the financial media and certain well-known personalities in the market have mistakenly associated the word risky or dangerous with options. The individual investor should consider both sides of the argument before deciding on the worth of options. Options may offer an investor four main benefits, in no particular order. With benefits like these, it is understandable that individuals who have been utilizing options for some time would be perplexed as to why they are not more well-liked. Let's examine each of these benefits individually. 1. Cost efficiency. Options have a lot of leverage. As a result, an investor can acquire an option position comparable to a stock position while saving a ton of money. For instance, an investor would need to shell out $16,000 to buy 200 shares of an $80 stock. The total cost, however, would only be $4,000 if the investor bought two $20 calls, each representing 100 shares, two contracts, times 100 shares per contract, times $20 market price. After that, the investor would have an extra $12,000. It is not nearly that easy. The investor must choose the best call to acquire to duplicate the stock position. However, this tactic, usually referred to as stock replenishment, is feasible and economical. 2. Lower risk when used properly. There are instances where purchasing options are riskier than holding stocks, but there are other circumstances where using options can help lower risk. It all relies on how you employ them. Due to the lower financial commitment required, options might be less risky for investors than shares and are more resistant to the potentially disastrous impacts of gap openings. Options are safer than stocks since they are the most reliable type of hedging. A stop-loss order is commonly issued to safeguard the position when an investor buys equities. The stop order is intended to halt losses below a certain price that the investor has specified. These orders have difficulty because of the way they are written. A stop order is implemented when the stock moves at or below the limit specified in the order. 3. Greater chance of returns. You don't need a calculator to understand that if you spend less money while earning about the same profit, your percentage return will be larger. Options often offered to investors when they are paid off. 4. More strategic options. Options also provide extra investing possibilities, which is its final significant benefit. Options are an incredibly adaptable tool. Options can be used in a variety of ways to replicate various positions. These positions are referred to as synthetics. Synthetic positions give investors several options for achieving the same financial goals, which can be beneficial. Although synthetic positions are regarded as an advanced option issue, options also present a wide range of additional strategic choices. For instance, when an investor wishes to short a stock, many investors use brokers who charge a margin. The price associated with this margin need may be very high. Other investors work with brokers who categorically forbid shorting stocks. Investors are effectively handcuffed and forced into a world of black and white while the market trades in color because they cannot play the downside when necessary. However, no broker regulation prohibits investors from buying puts to play the downside, making this a clear advantage of trading options. The investor can trade in the market's third dimension or lack of direction using options. Options allow the investor to trade not just changes in stock prices, but also time and volatility changes. Most of the time, stocks don't make significant changes. The few equities that do move dramatically do so rarely. Your capacity to capitalize on stagnation may be the difference between realizing your financial goals and keeping them as distant aspirations. Only choices provide the tactical options required to succeed in any market. Risks of options trading. Thousands of fresh investors opened brokerage accounts after the pandemic. Sadly, few purchased quality equities to hold on to them. Instead, they experimented with high-risk, high-reward tactics like options trading. If you intend to trade options, you must know all the associated risks. Buying and selling contracts based on the value of an underlying asset, like a stock, bond, commodity, or currency, is a high-risk investing strategy known as options trading. Due to its potential for significant profits and capacity to provide leverage, it appeals to many investors. However, options trading comes with several risks that, if not properly managed, can result in severe losses. Investors should be informed that options trading can be risky and there is a chance of losing money. The possibility that an investor would be exposed to more risk than they can handle is one of the major risks of trading options. Investors must be sure they understand the risk they are taking on and have the financial resources to pay their losses because the leverage obtained by using options can magnify both gains and losses. Trading options also involve a liquidity risk. The investor might be forced to honor the contract and incur a loss if they cannot find a buyer or seller in time. Additionally, when expiration draws near, the time value of options contracts declines, which can further diminish the value of the investor's position. The potential for mispricing is the third risk associated with trading options. It is conceivable for the market to be mispriced, resulting in unanticipated losses for the investor, given that the pricing of options contracts depends on intricate mathematical models. Option contract pricing is also open to speculation, which increases the risk of sudden, significant price changes. Finally, counterparty risk is a risk associated with options trading. This is the danger that the other party to the deal won't carry out their end of the bargain, costing the investment money. Investors must ensure they only trade with reputable brokers or exchanges governed by the appropriate authorities if they want to protect themselves from this. In conclusion, trading options can be profitable, but big risks are involved. Before trading, investors must know the risks involved and have the money to cover any potential losses. To prevent mispricing and unforeseen losses, investors must also ensure they are trading with trustworthy brokers or exchanges and know about the pricing of options contracts. Chapter 2. Understanding the options market. From a simple approach to detailed, complex trades, you can use various options trading strategies. However, betting on rising prices is generally done by trading call options, and betting on dropping prices is done by trading put options. Option buyers and sellers must exchange at least 100 shares of stock or other assets. However, there is no requirement to exercise options if a deal doesn't make money. Investors will only lose the price they paid to buy the contracts if they decide not to exercise their options. Consequently, trading options can be inexpensive to speculate on various asset types. What are the different types of options? If you're an investor looking for short-term financial instruments, option is perfect for you. It is a derivative contract that grants the owner the authority to purchase or sell securities within a predetermined time frame at an agreed price. Call and put options are the widely known, even though several options are available on the stock market. Call option. Simply put, a call option implies a right to buy. It gives the contract's owner the choice to buy a stock at the decided upon strike price at any time up until or on the day the contract expires. When the market is bullish, an investor will buy this option because they believe the stock's market price will increase in the future. By exercising the option and buying the shares at the striking price, which is less expensive than the current market price, the option holder can benefit as the stock price increases. Put option. On the contrary, a put option grants the owner the right to sell. Within the expiration term, a put holder may sell the option as a stock at a strike price. A put option is placed when an investor anticipates a future decline in the market's price, a bearish market. The put holder can sell the asset at the strike price, higher than the current market price, as the underlying asset's price decreases in the open market. As a result, the investment is successful. Understanding the essentials of option prices. Options contracts give the buyer or investor the right, but not the obligation, to buy and sell a security at a predetermined price known as the striking price. Options contracts trade on options exchanges and have an expiration date known as an expiry. Because they draw their value from the underlying security or stock price, options contracts are considered derivatives. The buyer of an equity call option will want the underlying stock price higher than its strike price by the time it expires. Conversely, a put option buyer would prefer that the underlying stock price is below the put option strike price by the time the contract expires. Numerous variables affect the cost of an options premium and, ultimately, the feasibility of an options contract. The following two elements are the most crucial in deciding whether an option is profitable when called in the money, ITM, or unprofitable when called out of the money, OTM. Intrinsic value. One of the key elements affecting the premium of an option is its intrinsic value. Intrinsic value is the portion of the premium of the price difference between the current stock price and the strike price. Consider a call option that an investor has on a stock that is now trading at $49 per share. The option's premium is $5, and the strike price is $45. Since the option's strike price was increased by $4 since it was established, $4 of the premium's $5 total represents intrinsic value. The investor in the illustrated case pays the $5 upfront cost and receives a call option that entitles him to buy shares at the $45 strike price. It won't be exercised until the option is profitable or in the money. By adding the premium to the strike price, $5 plus $45, we can determine the amount the stock must rise for us to profit, $50. The break-even point is $50, which means that the stock must increase beyond $50 before the investor can benefit, net of broker commissions. To calculate the portion of an option's premium that is attributable to intrinsic value, an investor would subtract the option's strike price from the stock's current price. Intrinsic value is significant because it increases the likelihood that changes in the price of the underlying stock will have a greater impact on the option's value and profitability. The level of a stock's price movement is known as its volatility. Assessment of intrinsic value. The term delta refers to an option's sensitivity to changes in the underlying stock. Investors should expect the option to move around 60 cents for every buck the stock moves, while a delta of 1.0 indicates that the option will possibly move dollar for dollar with the stock. The fact that the delta for puts is shown as a negative number illustrates how the link between the put and the stock movement is inverse. If the price falls $1 per share, the value of a put with a delta of negative 0.4 should rise by 40 cents. Time value. Time value is the monetary worth attached to the time left before an option expires. The more time value is built into the option's premium, the closer the option's expiration date is. In other words, time value refers to the fraction of the premium over the intrinsic value an option buyer pays in exchange for the right to possess the contract for a specific time. Time value is hence often referred to as extrinsic value. If an option has time left until expiration, investors are ready to pay more for it because there is more opportunity to make money. Since investors are ready to pay for that additional time for the contract to become profitable or have intrinsic value, the longer the time left, the higher the premium. Remember that for an option to have intrinsic value, the underlying stock's price must rise above the strike price. The likelihood that a stock's price will rise over the strike price and into profitability increases with the length of the contract. Because of this, time value is important in determining an option's premium and the possibility that the contract would expire in the money. Time decay. As the option expiration date draws near, the time value gradually lowers. An investor's incentive to pay the premium decreases as an option's remaining time decreases since there is less opportunity to benefit from the option. The possibility of making a profit decreases as the option's expiration date approaches, which causes the time value to decrease. Time decay is the process by which the value of time decreases. During its first half, an options contract typically loses around 1/3 of its time value. As the option's expiration date approaches, its value falls off increasingly rapidly until it eventually reaches zero. Investors must consider both time value and time decay when estimating the likelihood that an option will be profitable. There must be enough time left on the option to make a profit if the strike price is far from the current stock price. Determining whether an option has any chance of having intrinsic value requires understanding time decay and the rate at which time value depreciates. Evaluation of time value. The Greek letter theta represents time value. Theta reduces the premium. Thus, option buyers must be adept at market timing. Allowing a profitable trade to sit so long that theta significantly decreases the gains is a mistake many option traders make. For instance, a trader might purchase an option for $1 and watch it rise to $5. Only $4 of the $5 premium is intrinsically valuable. The option's premium will gradually decrease to $4 at expiration if the stock price doesn't rise any further. Before purchasing an option, a clear exit strategy should be established. Volatility and time value. A stock's volatility, or degree of price swings, also influences the likelihood that an option will expire in the money. If traders anticipate volatility, implied volatility, sometimes referred to as vega, can increase the option premium. The market's perception of the likelihood that the price of a stock will change is measured by implied volatility. Options traders will ask for a greater price for the options they sell, since excessive volatility increases the likelihood that a stock will move past the strike price. This is why well-known occurrences like earnings often result in lower profits for option buyers than initially anticipated. Even while there is a chance that the stock would move significantly, option prices are typically high before such occurrences, which reduces the potential rewards. In contrast, option prices tend to decline during periods of extreme calm, making them reasonably priced to purchase. However, the option will remain inexpensive, giving a limited chance for profit until volatility increases again. Chapter 3. Technical Analysis for Options Trading. Investors and traders often use the popular technical analysis tool to help them decide what to do when trading stocks and options. Technical analysis provides clearer entry and exit signals for generating money in the markets for many options traders. Technical analysis, when applied correctly, has a lot of empirical evidence to support it as a trustworthy trading technique, even though some investors disregard it as arbitrary and inconclusive. Any successful trader must be able to utilize technical analysis to its fullest potential. Technical analysis used properly, along with volume analysis, can increase your advantage in every trade. Understanding that these evaluations are valid even without a key event like a lawsuit or merger and acquisition discussion is crucial. These ideas make it easier to see trends and reversals, gauge the strength of an asset's momentum, and identify potential support and resistance locations. Important technical indicators for trading options. Depending on their trading style and the kind of security they want to trade, traders can use any one of hundreds of technical indicators. This section focuses on several significant technical indicators well liked by options traders. In short-term trading, technical indicators are often employed to assist the trader in determining the movement's range, how much, direction, which way, and duration, how long. The holding term is important since options are subject to time decay. While an options trader is restricted by the small period determined by the option's expiration date, a stock trader can retain a position indefinitely. Given the time limits, momentum indicators, which tend to spot overbought and oversold levels, are well liked by options traders. Let's examine a few typical indications that options traders utilize, such as momentum and others. RSI, or Relative Strength Index. The Relative Strength Index measures a security's pace and change of price movements to identify oversold and overbought conditions. It is a momentum indicator that contrasts the size of recent profits against recent losses over a given period. The RSI scales from 0 to 100, with values above 70 often suggesting overbought levels and below 30 generally indicating oversold levels. RSI is more effective for options on specific stocks than indexes since individual equities exhibit overbought and oversold positions more often. For short-term trading based on RSI, highly liquid, high beta stock options are the ideal prospects. Bollinger Bands. Bollinger Bands are a common tool to evaluate volatility, and all options traders are aware of the significance of volatility. As volatility rises, the bands widen. As volatility falls, they narrow. The likelihood of security being overbought or oversold increases with the distance between the price and the upper and lower bands. The security may be ready for a reversal if the price moves outside the bands, and options traders can position themselves accordingly. For instance, the trader might open a long put or short call position following a breakout above the top band. On the other hand, a breakout below the lower band would offer a chance to employ a long call or short put strategy. Additionally, remember that it is often a good idea to sell options during high volatility when option prices are high and to buy options during low volatility when they are more affordable. Intraday Momentum Index, IMI. The Intraday Momentum Index is a reliable technical indicator for high-frequency option traders wishing to wager on intraday movements. Indicating overbought and oversold levels, it combines the ideas of intraday candlesticks and RSI to provide a proper range, similar to RSI, for intraday trading. An options trader may be able to identify possible chances using IMI to place a bullish trade during an intraday correction in an uptrending market or a bearish trade during an intraday price bump in a downtrending market. The IMI is determined by dividing the total of up days by the sum of up days plus the sum of down days, or IS up divided by IS up plus IS down, and multiplying the result by 100. The most popular time period is 14 days, though the trader can select any number of days. Like RSI, the stock is overbought if the resultant figure exceeds 70, and the stock is regarded as oversold if the outcome is less than 30. Money Flow Index, MFI. MFI is a momentum indicator incorporating price and volume information, also called volume-weighted RSI. A number above 80 indicates that a security is overbought, while a rating below 20 suggests that a security is oversold. The MFI indicator analyzes the entrance and outflow of money into an asset over a specified period, usually 14 days, and is a sign of trading pressure. MFI is more suited to stock-based options trading as opposed to index-based options trading and longer duration contracts because it relies on volume data. A trend change can be anticipated when the MFI goes in the opposite direction of the stock price. Put-call ratio indicator, PCR. The put-call ratio compares the trading volume of call and put options. The variations in the put-call ratio's value rather than its absolute value represent a shift in the market's mood. When more calls are being purchased than puts, the ratio is above 1, which denotes bullishness. When the put volume exceeds the call volume, the ratio is less than 1, which denotes bearishness. The put-call ratio, however, is sometimes viewed by traders as a contrarian indication, leading them to choose to trade against market trends in anticipation of an eventual reversal. OI, open interest. The open or unsettled contracts and options are indicated by open interest. OI gives clues about the strength of a certain trend but does not always point to a specific uptrend or downturn. A strengthening trend is indicated by dropping open interest, while an increase in open interest signals new capital intake and, consequently, the sustainability of the current trend. Charting patterns and trends. A chart pattern is a shape within a price chart that helps predict what prices may do in the future based on prior performance. Technical analysis is based on chart patterns, which demand traders to be fully aware of what they are looking at and searching for. The most crucial thing to remember when employing chart patterns in your technical analysis is that you are not a guarantee that a market will move in that anticipated direction. Rather, they are only a potential outcome for the price of an asset. Shoulder and head. A shoulder and head chart pattern has two slightly smaller peaks on either side of a huge peak. To forecast a bullish to bearish reversal, traders look for shoulder and head patterns. The first and third peaks will often be smaller than the second peak, but they will all revert to the same degree of support, or the neckline, as a result. The third peak is expected to break out into a bearish decline once it has retreated to the level of support. Double tops. A double top is another pattern that traders employ to draw attention to trend reversals. An asset's price will often reach a peak before declining to a level of support. Then, it will ascend again before turning around more permanently against the current trend. Double bottoms. A double bottom chart pattern indicates a period of selling that caused an asset's price to fall below a level of support. It will then increase till a point of resistance before declining once more. Finally, as the market turns more positive, the trend will invert and start moving upward. Because a double bottom signals the conclusion of a downtrend and the beginning of an upswing, it is a bullish reversal pattern. Rounding bottom. A rounded bottom chart pattern might indicate both a continuation and a reversal. For instance, an asset's price during an uptrend may decline briefly before rising again. This would continue the positive trend. An instance of a bullish reversal rounding bottom is when the price of an asset is in a downward trend while developing a rounding bottom before the trend reverses and starts a bullish uptrend. Traders will attempt to profit from this pattern by purchasing halfway around the bottom, at the low point, then profiting from the continuation after it breaks over a level of resistance. Cup and handle. A bullish continuation pattern called the cup and handle is used to illustrate a period of bearish market sentiment before the general trend finally moves in a bullish direction. The cup resembles a rounding bottom chart pattern, while the handle resembles a wedge pattern, discussed in the next section. The price of an asset will probably experience a brief retracement after the rounding bottom. This retracement is called the handle since it is limited to two parallel lines on the price graph. Eventually, the asset will break free of the handle and resume its general bullish trend. Wedges. Wedges develop as the distance between two sloping trend lines for an asset's price change tightens. There are two types of wedges, namely, rising and falling wedges. A trend line wedged between two upwardly sloping lines of support and resistance is an example of a rising wedge. In this instance, The support line is steeper than the resistance line. When an asset price breaks through the support level, it usually indicates that the price will decrease more drastically. A falling wedge happens between two levels that are inclined downward. The line of resistance, in this instance, is steeper than the line of support. A falling wedge typically signals that the price of an asset will increase and pass through the level of resistance. Rising wedges are reversal patterns that indicate a bearish market, while falling wedges indicate a bullish market. Flags or pennants. Pennant patterns or flags are formed after an asset experiences a period of upward movement, followed by a consolidation. In most cases, the trend will begin with a substantial gain before degenerating into smaller upward and downward moves. Pennants can indicate a continuation or a reversal and be bullish or bearish. Pennants can be viewed in this context as a bidirectional pattern because they exhibit continuations or reversals. Even though a pennant design resembles a wedge pattern or a triangle pattern, both described in the next sections, it's vital to remember that wedges are thinner than pennants or triangles. Additionally, a wedge is either rising or descending, whereas a pennant is always horizontal, making wedges different from pennants. Ascending triangle. The ascending triangle represents the continuance of an uptrend and is a positive continuation pattern. A horizontal line can be drawn along the swing highs, the resistance, and an ascending trend line can be formed along the swing lows, the support, to create ascending triangles. Ascending triangles often have two or more peak highs that are identical, making it possible to create a horizontal line. The horizontal line denotes the degree of historical resistance for that specific asset, while the trend line represents the pattern's overall upward tendency. Descending triangle. A falling triangle, on the other hand, denotes a bearish continuation of a downward trend. A trader typically opens a short position during a descending triangle to profit on a sinking market, maybe using CFDs. Because descending triangles signify a seller-dominated market, they typically move lower and break through the support, making successively lower peaks more common and unlikely to reverse. A downward sloping resistance line and a horizontal line of support indicates descending triangles. The trend will eventually breach the support, and the downward movement will continue. Symmetrical triangle. The symmetrical triangle formation can be bullish or bearish, depending on the market. In either case, it is typically a continuation pattern, which indicates that after the pattern has formed, the market will typically keep moving in the same direction as the general trend. Symmetrical triangles are formed when the price converges with a string of lower peaks and higher troughs. The symmetrical triangle sometimes reveals that there has been a brief period of upward reversals, even if the general trend is bearish. The market could, however, break out in either direction if there is no discernible trend before the triangle pattern takes shape. As a result, symmetrical triangles are a bilateral pattern and are best applied in choppy markets where it is unclear in which direction the price of an asset will likely move. Chapter 4. Fundamental Analysis for Options Trading. Along with technical analysis, TA, fundamental analysis is one of the two primary techniques investors employ to uncover profitable investment opportunities for strategies like value investing or growth investing. Here, we will define fundamental analysis, describe its process, and provide examples. What is fundamental analysis? Fundamental analysis, FA, is a technique that helps to assess if a security or asset is trading at a discount to its value or a premium. It is often used in stock markets and for bonds, currencies, commodities, and even cryptocurrencies. FA is based on the theory that market prices might occasionally overvalue or undervalue an asset because they don't consider all important fundamental considerations. Investors take into account various economic and financial elements, including the overall health of the economy, the level of competition, or the financial statements of each asset or security, everything that affects a particular economy. Finding all of the available data and making inferences about which variables could affect supply and demand are similar to research when determining what might impact the price of a firm's stock or a particular commodity. How is fundamental analysis done? Depending on the method, Investors undertake fundamental analysis by either assessing the health of the general economy before focusing on the specific performance of a stock, or vice versa, by examining a specific company's financial performance. Together with technical analysis, TA, which assumes that market prices accurately reflect all fundamental factors rather than using historical price and volume data to forecast future prices, fundamental analysis is one of the primary techniques used to identify new investment opportunities. The main objectives of fundamental analysis are to find the asset's fair or intrinsic value and determine whether it is under or overvalued. The fundamental trading mechanics. A thorough examination of the economy, the sector in which the firm operates, and the company itself form the foundation of the basic method of valuing a company. The trader uses the information from this study to predict market trends and calculate the stock's intrinsic value. The trader can also use fundamental analysis to evaluate if a stock is undervalued or overvalued and to help anticipate the future value of the stock. Successful analysis can reveal investment opportunities that the market hasn't yet identified and help the trader make a successful investment. The trader might apply various methodologies while performing a fundamental study on a company. The trader may decide, for instance, to contrast businesses within a given industry with businesses in other industries. Examples of fundamental analysis in trading. The success of a trader's application of fundamental analysis depends on various variables. Thinking about the target trade's possible profit is a smart place to start. It's crucial to understand the different ways that fundamental analysis can help in the identification of potentially profitable transactions, as well as the reasons behind why such trades might be profitable. Here are two instances of how fundamental analysis could be used to locate potentially profitable investments. Established stocks. Established businesses, mutual funds, and other sizable financial institutions make significant market swings and can help investors build their portfolios. In this situation, a trader's profit will serve as payment for the risks they took. You can use fundamental analysis in various methods to decide whether an investment in a well-known publicly traded stock has the potential to be profitable. The goal is to weigh every piece of information influencing the stock's price. Traders will first consider the present economic climate, which includes national and international events that could impact the company and its stock price. For instance, are there any local problems, like wars or labor strikes, that would make it difficult for the business to get the supplies it needs to produce goods? Are macroeconomic issues, such as rising interest rates or inflation, impacting the company's pricing structure? What is the outlook for the business sector as a whole? Are there any disruptive elements that could have a detrimental effect on the company's market niche? A thorough investigation of the company comes next in a fundamental trading strategy. It's critical to understand the organization's business model and revenue stream. The company's financial accounts will be reviewed by traders, who will look at the cash flow statements, income statements, and balance sheets going back at least 2 years. The trader will be looking for obvious signals of growth during this assessment and efficient management that may mitigate any unfavorable macroeconomic circumstances and any competitive advantages the company may have that could spur future growth. Finally, the trader will do a competitive analysis of the company akin to the fundamental analysis already carried out. The trader will analyze findings for both the target company and its rivals to assess all the companies as viable investments. At this stage of fundamental examination, the trader may learn that the company has good investment potential or that a rival company has greater potential. Or, after some thought, the trader can decide that none of the studied companies would make good buys right now. Initial public offerings. An initial public offering, IPO, can allow investors to profit from the difference between the price the stock will ultimately settle at and the stock's IPO price. Your profits as a trader serve as payment for the risk you assume. While many of the fundamental analysis methods described above are available to traders, they might not be sufficient to assess an IPO's potential for profit. Risk concerns may be associated with IPOs that a fundamental analysis cannot account for. For instance, conducting a fundamental analysis for IPOs in relatively new businesses can be difficult because there isn't much historical information available to evaluate and compare. Additionally, because of extensive media publicity, the price of an IPO stock can occasionally increase. Some investors buy in an IPO without doing their homework and due diligence because they are affected by herd instincts and follow the crowd. This may result in an initially high stock price that falls sharply once trading starts. Special considerations. Fundamental analysis is typically not used to make tactical, immediate decisions. The right move can be made at the proper time with the help of technical analysis. However, a fundamental analysis should be used strategically over a longer time frame. A trader can learn about the market's general health and the attractiveness of a particular security compared to other securities by using fundamental research. To choose when and how to respond to the information obtained through fundamental analysis, some investors prefer to use technical analysis. Chapter 5. Developing a winning options trading strategy. When done correctly, trading options are one of the most effective means to build long-term wealth. If you're a newcomer in the stock market or investing, you might not be familiar with options or option trading strategies. But don't worry, we've got you covered. In exchange for a premium given by the buyer to the seller, an investor can purchase or sell an instrument, such as a stock or even an index, at a certain price over a predetermined period through an option. This chapter will cover some of the top option trading strategies that we believe any trader or investor should, at the very least, be familiar with. But first, how do you choose the right strategy for your trading style? Choosing the right trading strategy. Even if you are an expert in options trading, you won't likely make much money unless you can put that knowledge to use and choose wisely which transactions to enter into and when. Deciding which strategy to employ is the most difficult aspect of planning each transaction. This is true if you are starting with options trading or don't have a thorough grasp of the many strategies that can be employed. Even seasoned traders occasionally find it difficult to choose the ideal strategy. At the same time, it is true that the more experience you have with options trading, the easier such decisions become. The truth is that there is no right strategy. There are more things to consider, and a strategy that can be effective in one situation may be unsuitable in another. A lot also depends on the individual because what is right for one trader might not be right for another. Although we can't guarantee that you'll use the right approach in any given circumstance, we can give you pointers on how to decide for yourself. Here, we examine a few of the factors you should be thinking about. If you are still learning how to trade options, we advise you to take the time to determine the best approach each time you open a new position. As you gain expertise, your understanding of how each strategy works will improve, and you should have an easier time making decisions. What is your outlook? Your outlook on underlying security refers to what you anticipate will happen to its price, such as whether you believe it will increase or decrease. These are the only two perspectives in many types of investing that can be profitable. For instance, stock traders can either buy stocks they believe will appreciate or acquire stocks they believe will depreciate. These are essentially the only two ways to benefit. However, there are four possible outlooks for options traders to take into account: bullish, expecting the price to rise; bearish, expecting the price to fall; neutral, expecting the price not to change, or at least be reasonably constant; and volatile, expecting major price swings. This increases the number of things to consider and the number of ways to earn money. With so many options, you can hone your perspective to make the right choice. For instance, if you have an optimistic perspective, you may further classify it as somewhat bullish, expecting a slight price increase, or extremely bullish, expecting a large price increase. Choosing an effective plan is considerably easier when your outlook is more definite. For instance, if you anticipated that the price of an underlying investment would grow greatly, you would know not to employ a strategy that only made money on modest price increases and stopped making money if the price rose further. Additionally, you can mix outlooks. For example, you might anticipate that the price of an underlying security will increase over time but remain stable during the short term. Alternatively, you might forecast a very consistent price while considering the possibility of a decline. There are strategies you can employ in both of these situations. These examples emphasize how adaptable options trading is while emphasizing the value of having a precise outlook and taking the appropriate actions. As we have already indicated, When you become more familiar with the many types and begin to employ them, you will logically find it easier to select a strategy appropriate for your outlook. But you might find it harder unless you have a decent amount of experience. Risk versus reward. You must take risk management into account when deciding which tactics to employ. The risk profiles of the various strategies might differ greatly. Some have predetermined maximum losses, while others have unbounded risks. Becoming familiar with risk graphs may help determine whether a risk profile matches your personal risk tolerance. The risk-to-reward ratio is another important factor because it compares the potential profit amount to the probable loss. Single position or spread of options. Creating spreads is a key component of many options trading strategies since it allows you to combine many positions into one single one efficiently. Their main advantages are employing these spreads to reduce risk and lowering the initial investment required to take a position that can profit from several outcomes. As a result, employing spreads rather than opening a single position is typically a good idea. A few benefits to taking a single position are essentially just buying or writing one kind of options contract. First, entering a single position will cost you less in commissions than building spreads because fewer transactions are involved. This can significantly affect how profitable trades are, especially if you make many small ones. Spreads can occasionally reduce a trade's potential profitability, whereas taking a single position might result in bigger profits. Therefore, even though we believe spreads are often a better option, there may be times when a single position is a worthwhile consideration. Mandatory trading levels. Your broker will assign a trading level to your account, which will, in part, dictate which you utilize. To comply with regulatory requirements and prevent their clients from taking on more risk than they should, brokers assign each account a trading level mostly based on the client's background and financial status. You can only apply some strategies with a low trading level because those that involve a lot of risk call for a greater trading level. As a result, you must undoubtedly consider this while choosing your strategy in any given circumstance. Strategy complexity. There are many levels of strategy complexity when it comes to trading options. There are a few that are rather straightforward, usually those that require 1 or 2 transactions. Several require 3 or more transactions and are also more sophisticated. You should consider a strategy's intricacy when choosing one to use because it has an impact on a variety of trading-related factors. One reason is that you will spend more in broker commissions the more transactions you need, as we have explained earlier. You need to consider this because it can significantly impact your prospective returns, especially if you are trading on a tight budget. It can be difficult to determine a trade's potential earnings and losses and what price fluctuations will benefit you most if you use the more complex strategies. Choosing the best entry and exit points for a position is a crucial component of trade planning, and doing so is typically much easier when employing more straightforward strategies. However, you should be aware of the additional challenges this may bring. This does not imply that you should never use sophisticated ones because they are often the best option. The more difficult ones also present you with an additional decision, whether to execute all necessary transactions concurrently or execute each order separately. Many online brokers have features that let you choose your strategy, and the orders it needs will then be executed automatically and simultaneously. This greatly eases daily living. However, if you decide to use leggings, you must find the optimal location for each order and go through the procedure of placing each separately. This can make things a little more challenging, but you can increase your winnings if you can leg into and out of positions at the appropriate times. Options trading strategies for beginner. No matter how complex they are, call and put options are the foundation of all options strategies. Below, we have listed the 5 most common strategies, their return and risk breakdowns, and whether a trader might use them as leverage for their upcoming investment. These strategies, however simple, can help a trader make a lot of money, but they don't come without risk. Before we start, check out these primers on call options and put options. 1. Long call. By going long a call, the trader purchases a call in this strategy, expecting the stock price to rise over the strike price by expiration. The potential profit from this transaction is limitless, and if the stock rises, investors might make several times their initial investment. For instance, A call option with a $20 strike price and a 4-month expiration is trading at $1 for stock X, currently trading at $20 a share. One contract costs $1, each representing 100 shares, for a total cost of $100. Risk/reward. In this case, the strike price plus the $1 premium paid equals $21 per share, and the trader's price breaks even. For every dollar the stock increases above $20, the option's value rises by $100. The option expires worthless when the stock trades at or below the strike price. The potential gain from a long call is essentially limitless. The call's price may rise further if the stock keeps increasing before expiration. Long calls are among the most well-liked strategies to bet on a rising stock price. The risk of a long call is the complete loss of your investment, in this case, $100. The call will expire worthless, leaving you nothing if the stock closes less than the strike price. When to use. A long call is a wise alternative when you anticipate the stock will increase significantly before the option expires. The option might still be in the money if the stock climbs just slightly above the strike price, but it might not even pay back the premium, leaving you with a net loss. 2. Covered call. Selling a call option is going short in a covered call. In this case, the trader sells a call but also purchases 100 shares of the stock that underlies the option. The short call trade is made into a relatively secure, potentially lucrative investment by owning the stock. Traders anticipate that the stock price will be lower than the strike price at expiration. The owner must trade the stock to the call buyer at the strike price when the stock closes above the strike price. Example: shares of stock X are trading at $20, and a call with a $20 strike price and a 4-month expiration is trading at $1. One contract, $1, 100 shares represented each contract, or $100, is paid as the premium. The trader spends $2,000 to purchase 100 stock shares, then earns $100 by selling one call. Reward/risk. In this case, the strike price minus the $1 premium paid results in the trader's break-even price of $19 per share. Below $19, the stock would lose money, more than offsetting the $1 premium, causing the trader to lose money. The trader would hold on to the stock and preserve the full premium at exactly $20. The gain is restricted at $100 over $20. The short call loses $100 for every dollar over $20, but the gain in the stock completely offsets this loss, giving the trader only the initial $100 premium as profit. No matter how much the stock price climbs, the covered call's upside is constrained to the premium paid. More money cannot be made, but far more money can be lost. The short call entirely cancels out any profit you would have otherwise received from the stock's increase. If the stock drops to zero, the downside is a total loss on the investment, which the premium would mitigate. If the stock declines, the covered call exposes you to a large loss. For instance, in our case, the total loss would be $1,900 if the stock dropped to zero. When to use. If you already own the stock and don't anticipate it to climb considerably very soon, a covered call can be an excellent way to make money. Thus, the strategy allows you to turn your current possessions into a cash stream. It can be helpful in tax-advantaged accounts where you might otherwise have to pay taxes on the premium and capital profits if the stock is called. Covered calls are popular with older investors who need the income. 3. Long put. In this approach, the trader purchases a put, often known as a going long put, expecting the stock price to be lower at expiration than the strike price. If the stock declines dramatically, the potential profit on this transaction could be many times the initial investment. For instance, a put with a $20 strike price and a 4-month expiration is trading at $1 for stock X, currently trading at $20 a share. One contract costs $1, each representing 100 shares, for a total cost of $100. Risk/reward. In this case, the put is profitable if the stock closes at $19 per share at option expiration, which is the strike price less the $1 premium. Every dollar the stock falls below $20, The put's value rises by $100. The put expires worthless above $20, and the trader forfeits the $100 premium. Because the gain can exceed the cost of the option premium, the potential upside on a long put is virtually as good as that on a long call. A stock's upside is limited by the fact that it can never go below zero, whereas the upside of a long call is potentially limitless. A safer alternative to shorting a stock is to use long puts, another straightforward and well-liked strategy to bet on the stock's collapse. The highest loss on a long put is the premium, which is $100. The put expires worthless, and you lose your investment if the stock closes higher than the strike price at the time of the option's expiration. When to use. A long put is a wise investment when you anticipate that the stock will decline significantly before the option expires. The option will be in the money if the stock drops just slightly below the strike price, but it might not pay back the premium, leaving you with a net loss. 4. Short put. This strategy is the opposite of the long put. However, in this case, the trader sells a put, known as going short a put, and anticipates that the stock price will exceed the strike price by the time the put expires. The maximum a short put can earn is a cash premium, which the trader receives in exchange for selling. The trader must purchase the shares at the strike price if it closes below it at option expiration. Example: shares of stock X are traded at $20 each, and a put with a $20 strike price and a 4-month expiration is trading for $1. One contract, $1, 100 shares represented each contract, or $100, is paid as the premium. Risk/reward. In this case, the short put equals $19, the strike price less the premium received, or breaks even. For every dollar the price declines below $19, the short put costs the trader $100, while above $20, the put seller receives the full $100 premium. The put seller would receive a portion of the premium, but not all, between $19 and $20. The short put's potential gain is always limited to the premium paid, in this case, $100. The highest return on a short put is the amount paid to the seller up front, much like with a short or covered call. If the price fell to zero, the downside of a short put would be equal to the total value of the underlying stock less the premium received. In this case, the trader would have to invest $2,000 in the company, 100 shares, $20 strike price, but the $100 premium gained would negate this cost, resulting in a loss of $1,900 overall. When to use. A short put is the right course of action when you anticipate that the stock will close at the strike price or higher at the option's expiration. For the option to expire worthless and allow you to keep the entire premium paid, the stock must be at or above the strike price. If the stock is put to you, your broker will want to ensure you have enough equity in your account to purchase it. If the put expires in the money, many traders will have enough cash or margin in their accounts to buy the stock. Without purchasing the stock directly, it is easy to close out the options position before it expires and take the loss. Longer-term investors who would want to buy the stock at the strike price and receive some extra money in return for doing so may also find this technique beneficial. 5. Married put. This strategy is similar to the long put with a twist. The trader purchases a put in addition to owning the underlying stock. This is a hedged trade in which the trader anticipates a rise in the stock but seeks insurance if it declines. The long put counters any potential reduction in the stock price. For instance, a put with a $20 strike price and a 4-month expiration is trading at $1 for stock X, currently trading at $20 a share. One contract costs $1, each representing 100 shares, for a total cost of $100. For $2,000, the trader purchases 100 shares of stock and one put. Risk/reward. In this case, the married put breaks even at $21, the strike price plus the $1 premium expense. Under $20, the long put cancels out the stock's loss dollar for dollar. Even though the put expires worthless and the trader loses the premium paid, in this case, $100, The total profit grows by $100 for every dollar the stock increases over $21. In theory, the married put's maximum upside is limitless, less the put's cost, so long as the stock price keeps increasing. The premium is what it costs to insure the stock and provide it the chance to rise with little risk because the married put is in a hedged position. The cost of the premium is the married put's drawback. The put gains value as the value of the stock holding decreases, matching the loss dollar for dollar. Due to this hedge, the trader suffers the smaller option cost loss as opposed to the larger stock loss. When to use. When you believe a stock's price will increase greatly before the option expires but also risk falling significantly, a married put may be a wise investment. The married put enables you to keep the stock and benefit from possible gains if it increases, while still being protected from a substantial loss if it decreases. For instance, a trader who wishes to be covered may anticipate news, such as earnings, that could move the stock up or down. Chapter 6. Trading Options on Stocks. Knowing the different trading strategies that may be used to make the most profit is important because the stock market is becoming more difficult to navigate daily. Today's traders must understand that to maximize their profits from their trades, they need to be aware of the many strategies used by specialists rather than seizing the first opportunity they come across. These strategies can reduce risk and increase earnings. Traders can learn how to benefit from any stock's flexibility with some work. Here, we list the greatest option trading strategies for people to try. Your trading style will determine whether you choose to apply these strategies, but at the very least, if you know how they work, you will be more prepared to adjust to shifting market conditions. Bullish option trading strategies. Let's look at some bullish option trading strategies first. Bull call spread. The debt spreads subcategory of options trading strategies includes bull call spread. Consider buying a call option for a lower risk bullish bet if you are bullish on a company or ETF, but do not want to risk buying shares altogether. Meanwhile, call options can be expensive and expose you to higher risk than you are used to. Perhaps you're thinking, is there another way? Yes, that is the response. To lower your initial cost and risk, you could buy a bull call spread. In the bull call spread option, you can still purchase the long call option that expresses your bullish viewpoints, but you can offset some of that price by selling a short call option that is opposed to it, reducing your risk. You can create a bull call spread by buying one call option and selling another with the same expiration date but a lower cost and a higher strike price. This approach is also regarded as the best one for selling options. Bull put spread. The bull put spread options trading strategy is employed by options traders who predict that the underlying asset's price will rise gradually. This option typically belongs to the credit spreads group. The buying and selling of puts and calls are more involved than that, despite this options trading strategy not being the most complex. In other words, this spread consists of selling and purchasing a put option with a lesser strike. Theta decay would profit you in this scenario, given that the short put option will lose value more quickly than your long put option position. In this situation, executing a bull put option would be preferable because theta decay causes such a position to appreciate rapidly every day. This method is regarded as an excellent option purchasing strategy. Bull call ratio backspread. A trader must have a strong positive bias toward the stock to place this trade. Being just a little bit bullish won't help with this trade. One peculiarity of the bull call ratio backspread is that the highest loss occurs in the direction the trader expects the trade to progress. The bull call ratio backspread is one bullish strategy that could be employed instead of only buying call options. Selling one or more at the money or out of the money calls and buying 2 or 3 calls longer in the money than the calls sold to make up the call ratio backspread. This tactic is also regarded as the finest one for selling options. Synthetic call. An investor buys and holds shares to begin a synthetic call, otherwise known as a synthetic long call. The investor also purchases an at-the-money put option on the same shares as insurance against a drop in the stock's value. Many investors think of this method as an insurance policy against the stock dropping significantly while they are still holding the shares. Bearish option trading strategies. The trading strategies for bearish options are as follows. Bear call spread. A double options trading method known as a bear call spread may be used if one's outlook on the market is unfavorable. By employing this strategy, a trader will set a short-term call option while concurrently purchasing a longer-term call option with a higher strike price and the same underlying asset and expiration date. One obtains a net profit by obtaining a bigger option premium on the call sold than the cost purchased. Bear put spread. When a trader or investor believes that the price of a security or asset will drop slightly, they will use a bear put spread. A bear put spread is created by purchasing put options and selling an equal number of puts on similar assets with the same expiry date and a low target price. The highest profit a trader may achieve with this approach is the difference between these two strike prices, less the entire cost of the options. Strip. An optimistic investor on volatility and pessimistic on the market's direction must use the strip strategy. This approach involves buying two lots of at-the-money put options and at-the-money call options. Both alternatives must use the same underlying security and expiration month. A bearish form of the strip is identical to the standard long straddle. When the underlying makes a substantial move at expiration, moving more favorably towards loss, the strip strategy may produce significant winnings. Synthetic put. It is risk equivalent to buying a put option for an investor to sell short a stock and buy a call. By owning both a long call option and a short stock position on the same stock, this option strategy resembles a long put option. In a word, it's a strategy that traders might use if they have a bearish wager on stock but are worried about its likelihood of showing near-term strength. Assessing opportunities in various sectors. It's time to start planning how you'll identify trading chances at this point. Even if you are completely knowledgeable about options trading, your knowledge will be useless until you can put it all into practice and spot profitable trading opportunities. Even though options trading is extremely complicated, anyone willing to put in the effort to master the subject can eventually succeed. However, simply understanding how to trade options is insufficient. You must also understand how to profit from it. You will need to make the necessary effort to identify the right possibilities and then make the proper transactions. Thus, this requires hard work and dedication. If you can accomplish that regularly, your goals will likely be realized. This page examines how to find potentially successful options trading chances. Which underlying assets? Although options contracts are assets in and of themselves, they are derivatives whose value is derived from the underlying assets to which they are related. Stocks, foreign currencies, commodities, and indexes are just a few examples of the many underlying assets that can be used to buy and sell options contracts. Options trading is a particularly flexible type of investing since you can invest in various financial instruments simply by buying and selling options contracts. Choosing which financial instruments to include should be one of your first considerations when looking for prospective possibilities to trade options. It should be made clear that you are not required to choose to trade only stock, currency, or index options. You are free to buy and sell as many options as you choose. You do, however, need to consider how you'll research potential transactions and how you'll find relevant possibilities. Given the variety of options, you would have the best chance of discovering chances if you elected to take into account a variety of different underlying securities. However, you would need to be ready to invest a lot of time in researching various financial markets, which could make it difficult for you to find as many possibilities as you would like. Alternately, if you decided to exclusively trade stock options based on stocks in a particular industry, you could narrow your study to only publicly traded businesses involved in that industry. You might become an authority in that area and, using your knowledge, become much better at seeing possibilities relating to it. Of course, the disadvantage of adopting such a constrained strategy is that you might pass up many other opportunities in various industries and marketplaces you aren't even considering. There isn't a perfect way to go about this element of looking for possibilities, so we can't offer any advice on that front. It's up to you to choose what you feel comfortable with and what you believe will provide you with the best chance of success. But all we ask is that you take the time to think about the underlying assets you want to include. Using your expertise in a specific industry or market makes sense if you have it, but there is nothing wrong with adopting a broader perspective. You may choose to study the price changes of the options contracts and trade appropriately rather than investigating and analyzing the underlying assets of options. Making research. The emergence of online technology and intent has had various effects on trading and investing. Online brokers were created, as a result, greatly simplifying the process of purchasing and selling financial instruments. Financial instrument information is also now much more widely available. Investors benefit from the nearly endless supply of information available on the internet for research reasons. It is imperative to check the exchanges to obtain the most recent quotes and keep up with global events that may impact the markets. It is crucial to obtain financial data from publicly traded corporations. The internet is a fantastic information resource full of figures, facts, and statistics. Of course, conducting research for trading goals involves more than just acquiring information. The actual expertise is knowing what information to seek and how to interpret it. Even though it is a skill in and of itself, this skill may be readily improved over time with lots of practice. When identifying potentially lucrative prospects, you will give yourself a far better chance of success if you are willing to invest a reasonable amount of time in conducting research and assessing what you discover. Technical and fundamental analysis. As explained in previous chapters, the two primary tools traders and investors use to assess data and choose which trades and investments to make are fundamental and technical analysis. Despite serving essentially the same function, they serve that purpose in quite different ways. Fundamental analysis generally entails gathering as much data as possible about certain security and then analyzing it to ascertain its underlying value and how it relates to its trading price. For instance, if you wanted to perform a fundamental analysis on a stock in a specific company, you would look at various factors, including the company's current financial strength, earnings reports, the caliber of its management team, and its competitive edge in the market. By doing this, you could determine whether the stock was fairly valued compared to its underlying value or overvalued. Although it is oversimplified, this illustrates how fundamental analysis is put to use. The foundation of technical analysis is using historical data to forecast future moves. It entails looking for patterns in price and volume charts and graphs to identify trends likely to be repeated. According to the hypothesis, by observing these tendencies, you can accurately predict how the price of a security will change over a specific period. Even though this is a rather oversimplified version of technical analysis, it provides a basic summary of the process. Investors normally utilize fundamental and technical analyses when purchasing stocks, but they can also be useful when purchasing options. The basic concept is that you would utilize these techniques to understand how you anticipate the price of financial instruments to change, and then trade the proper options contracts to profit from those moves. Since there are many factors to examine, neither fundamental nor technical analysis can be regarded as superior to the other. In some ways, it boils down to personal taste. If you are more adept at or more at ease utilizing one of the strategies for your study, it makes sense to choose that strategy. You might find it more convenient to combine the two or to utilize fundamental analysis in some cases and technical analysis in others. But it's important to remember that, more often than not, options trading is about profiting from swift price changes. Fundamental analysis can assist you in understanding a security's intrinsic value, and long-term investors often use it to buy inexpensive equities that are expected to increase in value over time. It doesn't, however, always make it easier to forecast short-term price changes. Technical analysis can, which is why options traders will likely benefit more from adopting it. This is especially true for day traders making numerous short-term daily transactions. When finding possible transactions, you should also consider the amount of capital needed and the level of risk. Chapter 7. Managing Risk in Options Trading. First things first, what is risk management in options trading? This is the process of minimizing financial risk in your trading strategy by any means necessary. Each trader will manage risk differently. You must consider your risk tolerance to create a risk management strategy that will work. More aggressive traders can manage risk, although they won't control risk as much as conservative traders. It's crucial to understand that minimizing risk does result in a lesser possibility for profit. This is because many strategies you'll utilize include hedging your trades and exercising options early to benefit. A more aggressive trader may incur greater risk but also reap greater rewards. To begin with any investment strategy, it's crucial to take the time to create a trading plan that matches your risk tolerance. Why learning how to manage risk for stock options is so important. Aiming to maximize earnings is important, but learning how to manage risk for stock options may be more crucial. Why? Because continuously winning trades, no matter how small, results in higher overall returns than winning a few large trades while losing the majority. Consider this. Wouldn't you appreciate a stress-free trading approach that consistently nets you a 5 to 10% return on investment with every trade you make? Sure, the thrill of a home run is unbeatable. But over time, those singles pile up. Small, regular returns are preferable to high, irregular returns with plenty of losses. The best thing, though? You can still make a staggering profit with a successful risk management approach. 5 tips and tricks for managing risk when trading stock options. Are you prepared to understand how to control risk when trading stock options? There are numerous strategies to enjoy large rewards while minimizing your risk. We will outline our top options risk management strategies below, covering everything from using correct analysis to hedging your bets. Spend some time learning about options trading first. We are aware that you are eager to begin trading options. However, if you have no prior experience, start by trading options on paper. Paper trading simulates actual trading activities using fictitious funds. Before spending your hard-earned money, you can feel things and understand the highs and lows of trading. It is risky in and of itself to jump into options trading without first taking the time to build experience and confidence. Take profits. It can be enticing to keep waiting to collect extra earnings when an option contract is in the money early on. However, we advise you to use your options and to cash in on profits when you can. Let's say you buy an options contract from firm XYZ. According to the rules, your strike price is set at $10 per share with a 6-month exercise date for 100 shares. The underlying stock price has increased to $14 after 1 month. If you exercise your option, you'll make $400 immediately. But hold on. According to your technical analysis, the price may continue its upward path. Should you wait to extract an additional 1% to 2%? Sure, but you'll kick yourself if you miss the opportunity and the price changes before you can exercise the option. Here is a more effective method for trading options that enables you to collect earnings right away while leaving room for potential future gains. Assuming the example above is for a call option, you can now purchase those shares at the $10 strike price. Then, you can sell a portion of your shares at the $14 market price for quick cash. Then, when the price rises, keep retaining the remainder of your shares and gradually sell them off. Are you still holding the final 15% of your investment, and the price reverses? You are still in the black because you have taken profits until now. One of the best methods to manage risk with any trading strategy, including options, is to engage in what is known as selling into strength. Eliminate losses. We want to talk about the flip side of the coin, which is capping your losses when taking profits. Nobody wants to make a trade and lose money. Even if losses are rare, it is crucial to keep them in check. Even if most of your trades are profitable, you will still be in a deficit. Over a week, a month, or a year, you can still keep a good ROI on your capital by taking your medication and being willing to take minor losses sometimes. It's crucial to discuss time decay when it comes to trading options contracts in particular. Time decay is the term used to describe how your contract's value decreases over each day. Remember that your options contract is null and invalid after the exercise date. Additionally, as the exercise date draws nearer, time decay causes your contract's value to decrease. Regardless of whether you have money or not, this is true. Fortunately, the most you can lose on an options contract is the premium you paid to buy the contract. Options contracts are a wonderful value investment for traders because they are often rather affordable. If you don't intend to exercise your options, you have two options: let the contract expire, or sell it back on the stock market. Speculative investors could buy your contract and assist you in covering some losses, even if you might not receive the full value you paid for the contract. Diversify. You've probably heard of diversification if you've learned about investing. Putting all eggs in one basket will indeed guarantee failure. Therefore, when looking for options contracts to trade, diversify your portfolio by considering various industries, businesses, and options contract types. We should also discuss position size at this point. One thing you want to avoid is losing everything by blowing up your trading account. As a result, keep your position sizes to a reasonable portion of your working capital. Going all in on an easy victory might be very alluring, but you should resist investing more than 20% of your capital in any contract. This reduces risk and makes sure you have money on hand to invest in other possibilities that may arise. Purchase reliable stock prediction software. The best method to control risk in options trading or any other type of investing is to succeed in every deal you do. Not difficult. This is, unfortunately, not realistic. However, investing in a trustworthy, tried-and-true stock forecasting program will give you the best chance of success. But how precisely would this assist you in risk management? As a result of the insights the program gives you, you'll be able to buy contracts with more assurance. Even better, you can eliminate any ambiguity over when to acquire your contract or exercise your options. How? They offer a clear buy, sell, or hold recommendation for any given stock. A free stock analysis will show you how this works in practice. Using stock forecasting software to invest can help you manage risk better and win more deals. Simple indications enable you to evaluate opportunities and enter or exit the market at the ideal moment. Trading psychology and emotional discipline. Without prior direct investing experience, it might be challenging to understand trading psychology fully. Most traders know the importance of adopting and maintaining the proper mentality. The short-term trader will find this to be especially true. Making quick decisions on short notice will be necessary if you are day trading the markets, and they could mean the difference between winning and losing trade. The ability to adhere to a previously set plan where you are confident in booking profits and enforcing a stop loss is also required. Making time-sensitive trading decisions requires you to keep your emotions in check. The most common feelings that traders go through include fear, anxiety, conviction, enthusiasm, greed, and overconfidence. Fear/anxiety. Trading too large is a common source of concern. Trading at the wrong size unnecessarily increases volatility and lets you make mistakes you otherwise wouldn't make if you weren't under the pressure of potentially suffering more losses than usual. Another reason for your fear, or anxiety, is that you are in the wrong trade, which doesn't suit your trading plan. Conviction/excitement. The two main emotions you'll want to feed off are conviction and excitement, and you should experience these feelings in every trade you make. Conviction is the icing on the cake of each successful transaction. Therefore, chances are excellent that you aren't in the right deal for you if you lack either of these emotions. By right, we mean the transaction that complies with your trading strategy. Both profitable and unsuccessful trades have the potential to be losers. To keep yourself winning and losing on just profitable investments is the goal. This can be ensured by ensuring you are confident in a particular trade. Greed/overconfidence. You can grow greedy if you only want to make transactions you believe are highly likely to succeed. Although your greed may have resulted from your success, you could fall and experience a downturn if you aren't careful. Ensure your trade mechanics are sound, including keeping to stops, targets, adequate risk management, and sound trade setups. Overconfident traders who make poor decisions can halt a successful streak. How to improve discipline and control emotions while trading. Planning your strategy is essential if you want to keep negative emotions out of your trade. In financial markets, the proverb, "failing to plan is planning to fail," might be true. There are numerous ways to succeed as a trader. Some numerous ways and strategies might support traders in achieving their goals. But rather than being based on hunches, whatever will work for that person will often be a defined and systematic strategy. Here are some strategies to help you feel more in control of your feelings while trading. Make your own rules. You can better manage your emotions by creating your own rules for trading. Setting profit targets, stopping losses, and risk/reward tolerance criteria for entering and exiting trades may be part of your trading rules. Trade in the appropriate market context. Keeping away from less than ideal market situations is also wise. It's a good idea to avoid trading when you're not feeling it. Don't depend on the market to make you feel better. If trading isn't for you, the best action might be to stop doing it. Self-control, not money. Even though it sounds absurd, the first thing to do when entering the trading world is to put money aside. You might wonder how that is feasible. Trading is all about money. True and false. Each trader's ultimate goal is to use speculation to amass as much riches as possible. However, you must focus on things that produce money rather than the money itself to reach your goal. Start formulating trading plans and tactics. If you follow these steps correctly, you will see money coming in. Somebody is watching. Here is another tactic that you might find useful. Both seasoned traders and newcomers can use it. And what's the best? Applying is quite simple. If you've heard of well-known traders, consider the one you admire the most. If not, look up some well-known traders and choose one. The secret is to gain some knowledge of his traits, manner of trade, and successes. Learn as much as you can about this individual. On to the next action. Imagine that this man is behind you while you are trading. This man can see everything and judge you based on every trade you open and every dollar you invest. By doing this, you'll improve your self-control and cut down on your distracted time. Write a list. Everything that is connected to your trading operations in any manner should be noted down. What assets do you trade? When do you make a trade? The reason you trade. Make a list of specific, simple-to-understand goals and a timetable for achieving them. Print out the entire document. It should only take up 1 page. Then hang it where you can see it while trading. When in doubt, glance at the document to refresh your memory on the overall situation. You can keep up with other traders with a clear strategy and set goals. A day rule. Commit to maintaining your discipline for only 1 day. Today, I will follow my established guidelines and avoid engaging in emotional trading. That's all it takes. The majority of artists employ the same method. They tell themselves to sit down and draw one straight line when they are depressed and unable to practice. It won't be the only line when you're ready to practice. The second line follows the first, and you soon find yourself devoting several hours. Maintain your discipline not only for 1 day, but every day. You'll soon discover that maintaining discipline is much easier and has become second nature. Create a trading strategy and a trading journal. Planning for several outcomes in the lead-up to major news events may also be a strategy to consider underlying factors. The difference in performance between novice traders who use a trading plan and those who don't can be significant. The first step in combating trading emotions is to put together a trading plan, but unfortunately, this will not mitigate the consequences of these emotions. Keeping a journal for your options trading may be beneficial. Relax. You'll be more able to react logically to changes in the market if you're at ease and like your trading. Conclusion. Hopefully, you can decide if options are better for you with less difficulty now that you are familiar with the options, their 2 different types, calls and puts, and their risk level. The most crucial lesson is that you should know what you're getting into in advance, even though you might be anxious to join the options bandwagon. Options provide many ways for investors to make money by trading the underlying securities. Different combinations of options, underlying assets, and other derivatives can be used in several different methods. Buying calls, buying puts, selling covered calls, and purchasing protected puts are fundamental strategies for newcomers. Options trading has benefits over trading actual assets, such as downside protection and leveraged returns, but it also has drawbacks, such as the need to pay the premium in advance.
We appreciate you tuning in to one of our captivating audiobooks. For more immersive experiences, here is another audiobook we're certain you'll enjoy. Don't forget to show your support by liking this video, sharing what you loved about this audiobook in the comments section below, and subscribing for more captivating audiobooks like this. Thanks for being a part of our audiobook community.